rates low. That we think is going to be important for the recovery, and that leads us to think that cyclicals will not consolidate too far from these levels. And looking forward, at the start of a new cycle, we think that cyclicals should do well.
Jeffrey, we're going to wrap with you. Thank you. Jeffrey Sachs, head of EMEA Investment Strategy for Citi Private Banking. Just a reminder before I read the next story, the UK set to introduce quarantine rules for 14 days for all travellers coming into the UK from Monday. That has not gone down very well with most of the operators of rail or airline services. So let me give you the announcement. British Airways, EasyJet and Ryanair have launched their legal action against the UK government's quarantine, according to IAG. Airlines are bringing the legal action, and they've asked for their judicial review to be heard as soon as possible. The airlines want the government to readopt its previous quarantine policy, which was introduced back on March the 10th, which effectively only focused on high-risk countries and limitations on high-risk countries. So we will wait and see what happens with this legal action, but IAG and the other airlines clearly unhappy with the 14-day self-isolation program the UK intending to bring in. Juliana, out to you.
Thank you very much, Jeff. Let's dive into some of the key corporate stories in focus this morning. Kicking off with Airbus. CEO Guillaume Faury has warned UK staff they may face, quote, more permanent job cuts than their colleagues in France and Germany. Speaking to the Financial Times, Faury said the UK's decision to end its furlough scheme by October could see a more permanent reduction in the workforce. He urged the British government to recommit to the aerospace industry by pledging to protect jobs and wages in the sector over the long term, like France and Germany have done. Now, we are seeing a bounce in Airbus shares this morning, up about 4%. But like Jeff just brought you the news out of the airlines here in the UK, we are seeing a strong bid come together for the travel industry more broadly in the last moments. And Airbus, of course, very linked to that part of the ecosystem when it comes to air travel. Shares are trading higher along with the broader sector. Now, switching gears, Swiss exchange group SIX has leapfrogged into the top 3 League of European bourses after completing the takeover of Spanish rival BME. The 2.6 billion euro deal marks SIX's expansion into the European Union. It also ends the independence of the Madrid Borsa, which was founded nearly 200 years ago. Euronext was also considering a bid, but announced in March that it would give up on it, despite, quote, significant potential synergies. Deutsche Börse was also reportedly interested. Now, Swiss Exchange's CEO, Jos Dijsselhoff, will join us later today to discuss the details of the deal. That's first on CNBC at 10:35 CET, so be sure to tune in. Euronext has announced that Teleperformance will enter France's CAC 40 on June 22nd as part of the reshuffling of the index. The call center specialist will replace catering giant Sodexo, which has seen its share price slide during the coronavirus pandemic. Speaking to this show, Teleperformance CEO Daniel Julien said the outbreak may lead to long-term changes in remote working.
In the future, we are going to have a new balance between work at home and centers. Right now, I cannot say that our lease costs have gone down because, we have long-term lease as it's practicable.
The CEO of Teleperformance there. Fears of new lockdowns spread in the US as 1/3 of states see new COVID-19 cases rise by 25%. More details when we come back.
Start your day earlier and smarter, on top of the news.
Political turmoil and the Eurozone heating up.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
Did you know that with TuneIn's local radio feature, you can stream live FM and AM stations broadcasting in your area? Discover local news, talk, and music stations. Navigate to the local radio section under Browse to listen locally on TuneIn.
Hi, this is Mike Tirico, introducing you to Sports Uncovered, the newest podcast series from the storytellers at NBC Sports that will shine a fresh light on the most unforgettable moments in sport.
The reason why I'm smiling, I might get in trouble for this.
Search Sports Uncovered to start listening today.
While you wait for baseball season to begin, TuneIn has dug into the archives and blown the dust off some of the classic games in MLB history. Search classic game replays to relive some of the great contests in America's pastime. It's on demand, it's free, and it's only on TuneIn. With the NHL season temporarily on ice, now is a good time to catch up on past games.
Bergeron, he scores!
With game replay on TuneIn, you can listen to every power play, slap shot, and goal of the 2019-2020 season so far.
Suter, Zakana to Fiala, he scores!
And for a limited time, it's free for hockey fans everywhere. Search classic game replays to start listening.
Buckle up, race fans.
NASCAR is back in the driver's seat.
And you can cut straight to the action here.
With the Performance Racing Network on TuneIn, you can hear PRN's live coverage of some of this year's top events.
As NASCAR's top drivers, Kevin Harvick,
Clint Boyer, and more get back on the track.
Search Performance Racing Network to listen and see upcoming races.
Are you fully informed on the NBA? On the NBA Hangtime podcast, veteran sports writers Sekou Smith and John Schumann analyze the latest NBA news, storylines, and discussions with guests from around the basketball universe.
Isaiah Thomas joined us here on the Hangtime podcast. Isaiah, good morning.
Everybody's doing well. As you know, my daughter.
Welcome back to Squawk Box, everybody. Well, markets have been open for just about 20 minutes, but we've already seen a lot of action in European equities. The Stock 600 has now turned positive for the morning. It's currently up about 0.3% after opening on the back foot. And this, of course, follows a very difficult day yesterday for equities. The Stock 600 ended more than 4% lower, its worst daily performance since March 23rd. We saw broad-based losses come together yesterday, but the cyclical, most unloved sectors had been hit hardest. And early on in the trading session this morning, just about 25 minutes ago, they opened up on the back foot yet again. But clearly that trade has been reversing. Investors perhaps pausing, taking stock of the pretty drastic moves lower that we've seen over the last couple of days. And let's put this into context. We are trading this week after an extremely strong week last week where several markets in Europe gained more than 10%. So we have seen a stark pullback this week, but it comes after a very strong March higher last week. Let's take a look at the individual markets. If I can take you to the different regions and the split we're seeing. We did have some data come through today out of the UK. So British investors are taking stock of UK GDP data. In April, the economy shrunk by a record 20.4%. Sense of the extent of the damage imposed by the coronavirus pandemic and the lockdowns. The FTSE 100 trading now higher by the tune of about 10 basis points. We're also seeing gains in the DAX. The German market is marching higher to the tune of about 0.6% now. We're also seeing a bounce back in the CAC, up about 0.7%. And the Swiss index, this is a total reversal of what we saw in the opening trade just about 25 minutes ago. The Swiss index is now underperforming. At the start of trade, healthcare was the one of the best performing parts of the market. The Swiss index, therefore, one of the most resilient, now down about to 0.3%. It's the only one of these major indices that is trading in negative territory. And let's take a look at sectors and what the breakdown looks like this morning. If I can bring you the sector moves, we are looking now at healthcare, the worst performing sector in the market. So complete reversal. Of course, this is only 25 minutes worth of trading activity, so things could change even further. But very interesting to see that investors are changing their tune, again, perhaps pausing for breath after the dramatic moves we've seen recently. And moving along to the better parts of the market, we're seeing a bounce back in basic resources and oil and gas. Those two baskets did open up on the bottom of the Stock 600 first thing this morning. And the best performing parts of the market, travel and leisure, banks, and autos. So clearly we're seeing renewed appetite appetite for these cyclicals. This was the trade that a lot of momentum was building behind this trade over the last couple of weeks. It obviously, a spanner was thrown into the works this week with the Federal Reserve and the rise in infections in the United States, in certain parts of the states anyway. And now we're seeing a bit of a renewed appetite for those sectors. Let's take a look at U.S. futures. We are looking at an even stronger bounce for Wall Street than we were looking at just 25 minutes ago. So positive momentum building not only here in Europe, but also in the United States. The Dow now looking at a more than 400-point rise at the open. The NASDAQ and the S&P also poised for a stronger start. Jeff.
Juliana, you know, not everybody was happy about what the Federal Reserve had to say. President Trump attacked the Fed for the first time in months. Trump took to Twitter to signal his dismay over the central bank's grim economic forecasts following that latest policy meeting this week, saying the Fed is, quote, wrong so often. He added the third and fourth quarters will be very good and that the U.S. will see one of its best ever years in 2021, contradicting Fed Chair Jerome Powell's outlook. There is growing concern, though, that relaxing restrictions is causing a surge in COVID-19 cases in the U.S. 15 states have seen infections rise by more than 25% in just the last week. Meanwhile, U.S. Treasury Secretary Steven Mnuchin has told CNBC the American economy cannot afford another shutdown as concerns grow that certain cities are seeing a second wave of the pandemic.
We can't shut down the economy again. I think we've learned that if you shut down the economy, you're going to create more damage, and not just economic damage, but there are other areas, and we've talked about this, of medical problems and everything else that get put on hold. I think it was very prudent what the president did, but I think we've learned a lot.
Well, coming up on the show, we're going to be talking about one of my favorite topics, exit left. UK theaters warn they may soon run out of cash if the UK government doesn't specially step in. We'll discuss the outlook for the West End next.
Now get greedy whenever you want. Subscribe to the American Greed Podcast and
you love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
With millions of podcasts dropping new episodes all the time, how do you keep up with all your favorites? TuneIn makes it easy. Simply head to the home screen and find your new episode section to see the latest additions.
With the NHL season temporarily on ice, now is a good time to catch up on past games. With Game Replay on TuneIn, you can hear every matchup of the 2019-2020 season so far. And for a limited time, it's free for hockey fans everywhere. Search Classic Game Replays to start listening.
It's TuneIn Sports on this day. On this day in 1928, New York Yankee Lou Gehrig hits 2 triples and 2 home runs to beat the White Sox 5-7.
See Lou Gehrig come out in the first inning, and he ends up hitting a 2-run home run. He ends up hitting 2 home runs in that game, and one of those Gehrig home runs actually was an inside the park home run. Bob Musil also steals home in the 6th inning. And
to listen to conversations breaking down the moments just like this, search sports to be part of the discussion on TuneIn.
Looking for your daily fix of NFL news and analysis?
In that. So we had to blow it up and do Super Bowl predictions instead.
Look no further than the Pick 6 podcast, where CBS sports writer Will Brinson gets you up to speed with what's trending in the NFL that day, so that you're always in the know.
Yeah, it's pretty revealing of Brinson's methodology for predictions. When he gets mad at people for predicting good teams are going to win the Super Bowl or good players are going to win major awards, that's how you wind up.
Search Pick 6 on TuneIn to listen.
Where do sports, culture, and basketball nostalgia collide? On their podcast, Knuckleheads, NBA veterans Quentin Richardson and Darius Miles sit down with athletes, musicians, and entertainers to get brutally honest, totally unguarded conversations about everything from current events to untold stories from the golden era of sports.
Kill O'Neal. You know that, right? I tried to tip dunk all the free throw line one time.
Search Knuckleheads on TuneIn to listen.
While you wait for baseball season to begin, TuneIn has dug into the archives and blown the dust off some of the classic games in MLB history.
There it goes, 3-2 pitches, hit in the air and hit well. Center field, Bader back, at the wall, it's gone!
Search classic game replays to relive some of the great contests in America's pastime.
Ground ball out to Jackie Robinson, up with it over to Reese for one, back to Hodges, it gets away from him.
Welcome back to Squawk Box. European stock markets begin regaining ground as U.S. futures bounce back from Wall Street's biggest sell-off since the middle of March. Autos, banks, and travel stocks lead the gains, while oil stocks and tech underperform after the biggest U.S. names lose $270 billion in market value. The UK suffers the sharpest monthly contraction on record as GDP falls by more than 20% in April in the country's first full month of lockdown. Launching legal action. UK airlines challenged the British government's 14-day quarantine rule, asking the courts to consider their case as soon as possible. Markets in Europe have been open for half an hour now, and it's already been a very exciting 30 minutes. After opening in negative territory, extending the losses that we saw come through yesterday, the Stoxx 600 has now bounced into positive territory, trading about 10 basis points higher. Bear in mind, though, that we have come off the highs of the day, so clearly a lot of jitters still across the investors this morning, and this comes after a very sharp sell-off yesterday. The Stoxx 600 dropped more than 4%, so investors perhaps pausing for breath now as they decide what comes next, what will be the next catalyst for markets. This week, we, of course, had the Federal Reserve, and that meeting proving a bit of a catalyst for markets, selling off very strongly in the wake of that meeting as they vowed to keep rates near zero through 2022. And we also are looking at, on the healthcare side of things, a rise in the number of infections of coronavirus in parts of the United States, causing some concern around an escalation in the first wave, possibly a second wave in certain parts of the United States, in the Deep South and the West Coast in particular. Let's take a look at the sectors and what the breakdown looks like. We have got a split board, interestingly. So at the very start of trade this morning, we saw the most cyclical, unloved parts of the market underperforming, healthcare and other defensives outperforming. Now we've got a firm reversal of that coming through. So we've got autos, the best performing sector at this point, 1.5% higher. Real estate, banks, media, travel and leisure, and industrials. On the downside, we've got healthcare down 0.9%, the worst performer, and then telecoms, chemicals, household goods, food and bev, and technology. Let's take a look at the individual movers, the biggest gainers, biggest losers this morning. We've got Dufry, the duty-free company, up 6%, one of the best performing stocks this morning. Pearson shares and Informa also getting a boost this morning, up about 7% a piece. On the downside, it's a bit of a mixed bag here. One to point out, Tullow Oil down 4.5%, but we have seen a decent bid for oil and gas, the energy sector more broadly this morning. And let's take a little bit of a closer look at travel stocks in particular. We've got the airlines rallying very strongly now. We've got EasyJet, Ryanair, both higher by 4% and 2% respectively. Air France, KLM also trading higher, more than 4%. And as Jeff brought us the news before the break, we have seen legal action now launch from the UK airlines. They are pushing for a reversal of the UK government's decision to impose that 14-day quarantine for entrance to the United Kingdom. Now, speaking of the United Kingdom, let's take a look at the FTSE in a little bit more detail. Economic activity in the UK suffered its sharpest contraction on record in April, falling 20.4% in the country's first full month in lockdown. And a mixed picture here for some of the majors in the FTSE. We've got Barclays trading higher by 1.2%, but the healthcare names under a bit of pressure, again, feeding into that broader market theme this morning of a stronger bid for cyclicals now and a less of appetite for those defensive healthcare names. Jeff?
Thank you very much, Juliana. Over 70% of jobs in the UK theatre sector may be at risk due to coronavirus. That's according to the Society of London Theatre, which has warned that many companies may run out of cash by the end of the year if no action is taken. The organisation has urged the UK government to step in and help the performing arts sector This as artists and directors have cautioned that venues may struggle with the prospects of reopening if social distancing measures continue. Julian Bird joins us, the Chief Executive of the Society of London Theatre and UK Theatre. Welcome to the programme, Julian. Good to have you with us. Just make the case for us, would you? Because we can, I think, clearly understand why the aviation industry believes it's an essential service. Why should the theatres be saved? What's essential about the performing arts?
Well, thank you. Lovely to be with you this morning. Well, there's lots in what you have just said. I mean, just on the pure economic side, ticket revenues each year, somewhere between 1.3 and 1.5 billion pounds. Several hundred million to VAT. In that, just purely from VAT, the sector employs nearly 300,000 people at any one time. And of course, it is genuinely one of the sectors in which we lead the world. It's part of our history. We're net exporters in this field, not importers. And something that has taken, decades to build to the extent that we have. We're a growth industry. We've grown every single year for the last 10 years. Is obviously in huge peril.
Julian, what's been interesting is to see how much the theater industry has adapted through the lockdowns, making shows available to view at home. And we've now had a glimpse into what that looks like to, ingest culture online. How much of that should we expect to stay as we come out of lockdown? And is there a way to make that a more profitable part of the industry moving forward?
I think the answer to both your questions is undoubtedly yes. There has been more and more digital work happening, and the way to, if you like, monetize that is, of course, part of the future. But I think people have to remember that the shows, the productions that people are now watching at home, most often for free and being asked for donations, are productions that were filmed in the past. They were ones that were filmed at the end of a successful run with an audience in a theatre. So the cost of actually mounting that production, putting it on stage, rehearsing it, etc., was all built on ticket revenue from running for a number of performances, a number of months in a venue. The recording of it came at the end. If you like, it was the cherry on top of the cake. So, you're seeing historic things. You're not seeing new things being broadcast at the moment. The cost of setting one of those up just to record from scratch would be prohibitive economically.
Julian, a number of new shows were expected to come to the West End for later this year, and many of those shows have already sold out on tickets. What happens from here? Do you think that those shows will actually run down the track? And if so, will there be social distancing where you see some tickets refunded because you won't be able to have full audiences?
Well, of course, in the West End, we've been refunding, each theatre, each production has been refunding audiences on an ongoing basis. This has been going on for some months now. But yes, we firmly expect those major shows from Disney's Frozen and down to open. There's clearly going to be a delay. I will tell you, I know the pipeline of productions that want to open in the West End is still very, very strong. And I've no doubt we'll be back and be stronger than ever at some point in the future. But as you said, the major risk is around social distancing. At 2 meters, it puts the average theatre at only 20% of seats being able to be occupied. And at 1 meter, if we go down as a country to 1 meter social distancing, that means 30 to 35% of seats being able to be occupied. So with social distancing in place, it means that most theatres will struggle to open in any sense of normality. And clearly, without major government support, theatres, just from a pure money perspective, would struggle to make that work.
So, Julian, just to go down that route, I was going to go another way, but on social distancing, there will be no end to, even if we get to a metre, before we get a vaccine. There is no hope of a vaccine possibly this year, possibly forever. Who knows? I can't see, and I love London Theatre, by the way, and regional theatre, but every time I go into a theatre, I'm brushing past people's knees the whole time. They're brushing past mine. How on earth do you expect to open at all in these very intimate settings?
Well, I think you have to look at what's happening overseas. Our country is clearly in a particular phase of the pandemic at the moment. If we look at places like South Korea, their theatres have now been open, I think, sort of 5 weeks. Phantom of the Opera is playing very successfully in a full auditorium. There are plans now in New Zealand, in Australia, in parts of Europe to gradually release more and more seats and make that more economic in a seated auditorium. And the reason they're able to do that is that the infection rate is down at very, very low levels. Now, we as a country haven't got there yet, but we can look to other people who are starting to open their venues in totality with infection rates low. Now, let's hope we get there. None of those countries have a vaccine either. And, you know, we all know that society and the economy in all sectors will begin to open up. We may be one of the latter sectors. We acknowledge that. But, you know, we remain optimistic that we will be able to do more and more as the progression of this pandemic continues.
Julian, you've got a business and city background as well. You understand the very tight relationship between corporates, corporate sponsorship, largesse, and indeed the arts world as well. My anticipation is that corporates are more worried about their job situation, as indeed probably they should be, than the arts at the moment, albeit the arts are very important. What's happening to corporate sponsorship? I'd imagine it's being sidelined.
Some, I believe, is, but I will tell you that some people have remained remarkably strong in their long-term partnerships. You know, including, you know, as well as many, many things. I produced the Olivier Awards, and MasterCard have remained very loyal partners and have continued right through this and will continue with us, which is great. But yes, of course, money from all sources is coming under pressure. I mean, we haven't talked around overseas tourism. You know, if we just talk around the West End for a moment, about a third of tickets every year in the West End are bought by overseas tourists. It is a major part of what attracts people to come to London. In all the surveying done by everyone, not just us, by you know, the tourism authorities, that's what we know. And the likelihood of tourists being here in any great number for the rest of this year and into next year is very, very slim, as we all know. So even if our theatres could get back open without social distancing in place, we have a real challenge on consumer perception. And of course, we're doing lots of work around that, as well as lots of other people. So yes, corporate sponsorship, of course, is important. But I think it's more around ticket buyers and do audiences feel safe? Will people come on holiday here? Will they spend money in London? I suspect those are much bigger factors for us in the period ahead.
Julian, just stepping away from COVID-19 for a moment, I want to ask you about the Black Lives Matter movement, because there has been implications already for television shows and movies that have shown racial prejudice. They have been taken down. Clearly, a lot of musicals and plays tell a tale of history. What do you think the implications are for theatres and plays?
Well, let me first say I'm by no means an expert on this. You know, that's the first thing I think we have to acknowledge, and we need to listen to people who have a lived experience, which I clearly don't have. You know, theatre, we hope, is an all-embracing place. You know, I'm very sorry to hear some of the tales that have come out, even in our industry around the world, of people not feeling valued. And we all need to make a change in that. I mean, yes, theatre tells the story of history. You know, something like Hamilton is telling the tale of American history in a very new and innovative way. But what we clearly need to make sure is that the right people are involved in telling those tales, that the right people are involved on our stages and behind our stages in every area, creatively, and everything to do with putting the shows on. And we clearly need to make sure that people don't just feel that they feel that they are fully welcomed and fully part of our community. I hope that every sector will go through that. We certainly are going through that as a sector ourselves. And it's right that we do so. And let's hope that, you know, our stages in the future will tell the stories of all of this period, you know, the virus and Black Lives Matter and everything that society is going through, to remind us to look at ourselves for the future and what we can learn from the past.
Julian, we're going to bring down the curtain on this conversation, but thank you. Julian Bird, Chief Executive for Society of London Theatre and UK Theatre. Let's have a look at the market. The US futures implying that we will get a positive start to the trading session, but I have to say that Dow Jones number that had a 4 handle has now got a 3 handle. We seem to be losing some momentum. So we'll have a look when we come back at the market open. Stay with us. This is Squawk Box.
For me, Squawk Box is breakfast with the most interesting people in the world.
It's a privilege to get to talk. Looking to freshen up your listening on TuneIn? Head to the homepage to discover something new. There you'll see custom recommendations based on your listening habits, along with new episodes of shows you've enjoyed in the past. Uncover your next audio obsession on the homepage.
Are you ready for the realest first-hand take of what's happening in the NBA? On their podcast, All the Smoke, former NBA players Matt Barnes and Steven Jackson bring their fiery intensity to the mic, dishing on the latest news and drama from on and off the court without boundaries.
Half man, half amazing. My friend, our brother, Vince Carter, man. Welcome to the show.
Yo, what's up, man? What's up, my brother? Man, I'm good.
Search All the Smoke on TuneIn to listen.
Ready for some straight talk on what's happening in the MLB? On the Barstool Sports Podcast starting 9, Dallas Braden and Jared Carrabis cut through the BS to break down the league the way they really see it.
Yeah, we're continuing our little mini-series of college baseball coaches in addition to bringing you major league players from throughout the league. If you've been listening to Starting 9 for some time now, you know that we've had a big leaguer on every single episode for probably 2 years now.
Search Starting 9 on TuneIn to listen.
The Woj Pod with Adrian Wojnarowski.
Doris, you had reason to believe that you needed to get a test for the coronavirus.
Right. Well, let's just start with the headline, which is I did test positive for COVID-19. I was so tired from Saturday the 14th through Tuesday, March 17th. I kid you not, I could not be out of bed for 5 minutes without needing to go back to bed and lay down.
Search the Woj Pod to listen. To help keep you and your loved ones safe, TuneIn has the latest guidelines from the CDC. Avoid close contact with people who are sick. Remember, 6 feet, it's the rule. Stay your distance and always wear a mask while you're out. Avoid close contact with people who are sick. For the latest stories and updates on COVID-19, search Coronavirus News on TuneIn.
Ready for a one-of-a-kind look at the NFL? On the PFF NFL podcast, Steve Palazzolo and Sam Munson interpret the unique stats of Pro Football Focus to analyze the league, uncover secret superstars, and discuss which teams to watch out for in the next Super Bowl.
Let's talk some football. Let's do it, Steve. All sorts of stuff. We're going to do most improved defenses around the NFL. Solomon Wilcots, our very own. He went into some detail over it.
So, welcome back, everybody. We just thought we'd wrap up Squawk Box this morning by refocusing on these markets. This is current trading on the European exchanges. And as you can see, it's a little bit ho-hum, isn't it? The CAC has just pushed into positive territory briefly here. But by and large, we are weak on the European exchanges. And you know what? Markets tend to be very short-term, don't they? People react to the news flow and they take a decision on whether they buy or whether they sell. And they don't tend to look at the longer-term fundamentals until they're put in front of their noses and they have to take them on board. And that's kind of what the Fed did in the two-day meeting this week. Jay Powell had a whole slew of different scenarios in the economic forecasts, but effectively was saying we think rates are going to have to remain low well into 2022. And that was a kind of world that the markets, it seems, had not been preparing themselves for. So the US futures, as we were talking about this just before we went into the break, we've had a little bit of slippage away from the 400-point number implied in the US futures earlier on. And there's a good old battle going on at the moment as to which direction these US markets are going to go as we open up the session. And let's bring Steve and Karen back into the conversation. Feels like where we started 3 hours ago, but we've got some new information. Let me just spend a little bit of time very quickly on the week we saw both the Dow and the S&P effectively sending a message of weakening momentum as we went through the trading week here. And even as the NASDAQ had a look at the 10,000, couldn't close above it, then came back the next day and closed above it. We saw both the Dow and the S&P struggling effectively to show similar momentum. So Karen, let me bring you in because I know you're very focused on the technology story here, but even yesterday the NASDAQ couldn't buck the weaker tone?
It was a bit of a pause for breath, I think, if you look at the heady run for the Nasdaq. I mean, the falls yesterday are just over 5%, but for the week, the extent of the loss is only just over 3%, which is not very much, considering we saw a new bull market started on the Nasdaq early this week. We crossed 10,000 at the same time that the US is officially declared a recession. So it has been a very strong run on the Nasdaq. We're still above the 200-day moving average if you're looking at the technicals. It's been there for 34 straight sessions, and the size of the gains since the US election is 82%. So technology names have well and truly benefited from the recent cycle. But if you think about what we're seeing during COVID-19, there are key stocks that investors have been keen to own. Microsoft, Apple, Alphabet, they've outperformed the rest of the Nasdaq. Amazon, Facebook also managing to climb to fresh records. So investors picking up on remote working, that's benefited a lot of cloud solutions. The move towards more online delivery, e-commerce has certainly been worth about 50% of the gains that you've witnessed on the Nasdaq. So those are trends investors have picked up. But other big stock names, the likes of video conferencing, Zoom Video has been one of the new stocks investors have raked over. You've seen biotech, also a huge component of the Nasdaq. The likes of Moderna that's chasing a vaccine, Regeneron too, that's involved in the treatment process of COVID-19. So investors are looking at those particular names. Where there is a concern for investors, clearly these names have been bid up very aggressively. Entry point matters here in any sell-off if it happens again. The names that investors can sell and liquidate quickly, tech names, that is clearly an area where you need to be careful. That said, what we saw last time around, the first wave of the selling, investors looked at the sell-off as a re-entry point to names that they wanted to be positioned in the future. So I would say that there seems to be a support level for the Nasdaq. You may not find it across the rest of global equities, but I think the Nasdaq is a slightly different equation, Jeff.
Well, let's have a look at the Treasury market then, Karen, because for those who are playing at the moment in the markets, they will have seen a rebound in interest in the Treasuries as a result of perhaps some weakening in the investing in equities. Steve, you're looking at the 10-year for us.
Well, yeah, just to say, I mean, it's a very disingenuous point, but we heard it on the show earlier on when we were quizzing one of our guests, that if you buy the Treasuries and you believe that inflation is going to revert to mean of the last 10 years, then you are baking in a loss. You're not baking in a safe haven trade. You are baking in a loss. Let's go through it. And I just looked back, actually, funny enough, at the last 10 years inflation, just had a look at it in the United States. And I think you can make a fair argument that the mean inflation over that period is circa target, which is around about 2%. So let's just go through the yield curve. Yield curve, 2 years, trading at around about 0.2%. 0.2%. If you think you're going to get 2% inflation, you are losing money. 5-year, 0.3. 10-year was 0.666 overnight. Now I think it's just picked up a little bit on the yield, the underlying gone down a bit to around about 0.68. And if you have a 30-year paper, so 30-year paper, you're getting 1.4%. Again, you are baking in a loss compared with average mean inflation over the last 30 years as well. So it depends what you want to do. You want to scurry around in and out of the equity market, that's fine. But the fact of the matter is, if you go to the bond market, the safe haven trade is you're getting most of your money back, certainly not all of it. As far as the market's concerned as well, I just pick up on the other side of the coin that Karen was talking about, because I think we have, as a channel, got to really make the point that there are two different markets here. One, as Karen quite rightly says, these very bid-up names, the FANGs, the herded stocks, the technology, the Nasdaq, a large portion of which, just like 1999, by the way, do not make money. Some of them do. Some make bundles. Others don't. And then there's the rest. And there is a lot of stocks that have either gone into bear market or contraction territory, including an energy market, which is the best part of 40% lower from its 52-week high. Jeff.
Terrific. Let's bring Juliana into the conversation as well here, because she's going to kick you off with street signs very shortly as we come to the close of Squawk Box. The other bit of information yesterday, it seems to me, Juliana, that the market had to deal with is not only what the Fed had to say about the growth outlook, but it was the CDC talking about the risk of higher death numbers in the United States and fear around a second wave. I wonder if you could weigh in on that for us as it bears on this risk on trade.
Absolutely. I mean, first and foremost, whether or not it's right to call this a second wave, because in parts of the United States, which are seeing a rise in the number of infections, it's actually just the first wave. Places like Texas, which relaxed their lockdown rules pretty quickly, they are now seeing a rise in hospitalizations, which is very concerning. And I was reading some research out of Deutsche Bank. Robin Winkler did an analysis on cases in the United States, and he has cited, based on his research, Florida, Texas, and Arizona now have R values over 1, indicating that the virus is actually spreading actively. So this is definitely something that's weighing on sentiment as well.
Okay, Juliana, thank you very much indeed for that. We'll say goodbye to Steve and Karen for the time being as well, although they will both be back on street signs in just a moment. I will bow out, but as I do so, I just want to revisit this wall that shows you the European exchanges, because when we started that little run around the markets, only the CAC had gone positive. But since we've been having that conversation, some of the other European exchanges have slipped into positive territory. We will take a look at these when we come back with street signs in just a moment. Thanks for tuning in to Squawk Box. Bye-bye, everybody. Have a great weekend.
We followed Steph Curry and Under Armour from Hong Kong to Taipei to tell the story of
How do you keep track of all your favorite stations and podcasts? Easy. You add them to your favorites list. Just find the audio you want to bookmark and tap the heart icon. Then, whenever you want to browse your favorites, you'll find everything under the Favorites tab.
As the science and medical world continues to learn more about COVID-19, we're all learning how to best live with it. Because the news is always changing, TuneIn helps you make sure you're getting the latest information on the pandemic with live streams of CNN, MSNBC, BBC, and more. Plus, evidence-driven podcasts like Coronavirus, Fact versus Fiction, and Podcast 19. For the latest stories and reports, search Coronavirus News on TuneIn.
Ready to talk brass tacks on what's happening in Major League Baseball? Turn to the Effectively Wild podcast from Fangraphs for daily statistics, analysis, and commentary.
One team will say, yeah, we're going to keep paying minor leaguers their stipend, and another team will say, we're going to extend the stipend through this month, and then another team will say, nope, we're cutting them off. So are extending it at least through August, which would basically be the end of the minor league regular season.
Search Effectively Wild on TuneIn to listen.
Okay, here we go.
With the NFL draft in the books and the schedule set, check out a TuneIn podcast for daily updates on the lead up to the 2020 season. Like the Ringer NFL show, where a rotating cast of Ringer experts talk with players, coaches, and special guests about the NFL landscape.
A lot of the other teams that we consider...
Or ESPN's NFL Live.
If there are some delays because of the COVID-19...
Search sports on TuneIn to explore these pods and much more.
Brian Windhorst and the Hoop Collective podcast.
What about Giannis Antetokounmpo? He is going to be eligible to sign a Supermax extension, which we were projecting to be worth $240 million this summer. Well, if the salary cap drops, and even if he's wonderfully happy in Milwaukee, it may make no sense for him to sign when he can just wait a year and wait for the revenues to recover and then lock in.
Subscribe to Brian Windhorst and the Hoop Collective.
Search the Hoop Collective to listen.
Play, freedom to learn, freedom to simply be. Now more than ever, our freedom at home is what we're all thinking about. And for those times you wish you had a space to call your own. From patio covers to pergolas, from sunrooms to full room additions, and featuring the revolution in outdoor living, the Life Room, Four Seasons has got you covered, no matter your style or budget. To ensure your well-being, we offer contactless appointments. Our teams are temperature checked, wear gloves and masks, and maintain social distancing protocol. You can visit one of our deep clean showroom locations where we follow the same rules. In support of hardworking Americans, take advantage of easy payments, and for a limited time only, call now and save up to 40%. With products that are American-made, American-engineered, and all-American inspired. With easy payment options and limited time savings, it's time to let freedom in.
You bought life insurance to protect your family, but now your kids are grown and you could use more cash to enjoy your retirement or cover medical expenses. Well, you should know about Life Settlement by Benefit Advance. With Benefit Advance, you don't surrender your life insurance. You sell all or part of it for a lot more cash. Cash for retirement, medical bills, a family vacation.
morning, everybody, and welcome to Street Signs. I'm Juliana Tattlebaum, and these are your headlines. European markets fall in and out of positive territory as U.S. futures pair some gains after Wall Street's biggest sell-off since the middle of March. Launching legal action, UK airlines challenge the British government's 14-day quarantine rule, asking courts to consider their case as soon as possible. The UK suffers the sharpest monthly contraction on record as GDP falls more than 20% in April on the country's first full month of lockdown. And a resurgence in cases across the U.S. fuels fears of a second wave as the IMF calculates governments across the world have already spent $10 trillion. Lockdown.
The station you're listening to is experiencing technical difficulties. We
can't shut down the economy again. I think we've learned that if you shut down the economy, you're going to create more damage, and not just economic damage, but there are other areas, and we've talked about this, of medical problems and everything else.
And the SIX Group seals the deal with the BME after the Spanish exchange's shareholders overwhelmingly backed the near $3 billion takeover. I'll speak with SIX Group CEO Jos Dijsselhoff at 10:35 CET. Well, a very warm welcome to Street Signs, everybody, and happy Friday. It has been quite a week for markets, quite a morning for markets as well. We opened the day in negative territory, extending the losses that we've seen come together over the last couple of days here in Europe, but we've now bounced across the flat line into positive territory. The Stock 600 currently trading about 5 basis points higher, but it has been a very volatile, choppy session already. So clearly investors pausing for breath to a degree and trying to determine where markets go from here. The theme this week, certainly over the last couple of days anyway, has been this reversal of the trade into the more cyclical value parts of the market, out of the growth, quality, defensive parts of the market. That trade has been unwinding. But let's see what happens from here. We're now essentially flat on the day. Let's take a look at the individual regions in a little bit more detail. We've got green here for the German, French, and Italian markets, but just so. So the German market now well off the highs of the morning. We are seeing the FTSE 100 trade now below the flat line, but it's really been oscillation for all of these markets throughout the morning. And let's bear in mind, this comes after a very difficult day for Wall Street. We saw the worst day for equities since March as investors pulled their money out of the riskier parts of the market and put it into safe havens, which meant a higher demand for treasuries, higher demand for bonds like the Bunds over in the German bond market. Investors digesting not only the Federal Reserve meeting this week where they pledged to keep rates near zero until 2022, but also rising infection rates and hospitalization rates in some parts of the United States. So mounting concerns about the virus itself. And remember, all of this comes back to the health picture. So some concern now escalating around the trajectory of the United States outbreak. But Secretary Mnuchin, very importantly yesterday, made clear, speaking to our U.S. colleagues, that another full lockdown is out of the question for the United States. Let's take a look at sectors, what the breakdown looks like this morning. So fairly mixed picture. We have autos, media, banks, travel and leisure outperforming this morning. Autos very firmly in the leading position there, up about 1.9%. This rally that we've seen come together over the last couple of weeks into cyclicals was particularly beneficial for autos, banks, and oil and gas. And now on the downside, we got healthcare underperforming, down about 1%. Telecoms, chemicals, retail, food and bev, utilities now just a touch above the flat line. But clearly there is somewhat of a tilt in preference for those riskier markets as opposed to the more defensive parts of the market. Let's take a look at the progress we've seen over the course of the week. Taking a look at U.S. markets, we've got the Dow currently trading about 7.3% lower into today's session. The S&P this week down 6% so far, and the NASDAQ down about 3.3%. So this really is emblematic of the theme that we've seen come together together with this reversal of that catch-up trade where the cyclical parts of the markets became in favor in lieu of the more growth-oriented stocks, but now that trade reversing a little bit, and the tech-heavy NASDAQ is proving a little bit more resilient. Certainly has over the last couple of sessions anyway. Let's take a look at Asian markets now. Week to date, the moves that we've seen here are much more muted relative to what we've seen in the U.S. and also here in Europe. We've got the Shanghai Composite just a touch of negative territory for the week. The Shenzhen slightly higher actually on the week. So much more muted moves in Asia relative to what we've seen in other parts of the world. Let's bring in our first guest this morning, Brian O'Reilly, Head of Market Strategy at Mediolanum International Funds. Brian, thanks very much for being with us. It's really been an incredible week to be a market watcher. Can only imagine what it's like as a market participant. What do you make of the reversal trade that we've seen over the last few sessions? Investors pulling their money out of the more cyclical value parts of the market, putting it back to work in growth, defensive, quality stocks. Does that reversal trade have legs?
It's a really important question, and I think yesterday's action really was a shot across the bow for those investors pricing in a V-shaped recovery. Certainly over recent weeks, the market has been driven more by trading action than economic fundamentals. The reality we face is that COVID hasn't gone away, and as you rightly say, we are seeing a worrying uptick in cases in some states in the US, and we're still dealing with the deepest recession, in recent memory. So really the question is, where do we go from here? In a large part, that is dependent on whether the US can get COVID under control, but also in terms of the rotation in the market. And we'd look at the bottom of the cycle in terms of three phases. The first is during a downturn, the free fall that we saw back in March. It's really all about visibility, stability, and balance sheet strength. So sectors such as tech, healthcare, consumer staples, utilities tend to do better in that environment. But as we've seen, once investors get more confidence that economies are open back up, and I'd say we're not quite there yet, as we saw yesterday, then we get this rotation into industrials, financials, value, and small cap. What we are increasingly focused on is implementing some of those more cyclical sectors into our lower beta portfolios at the moment. But ultimately, we want to focus on some of the longer term trends that have emerged from COVID, such as the switch from digital consumption, from physical, more work from home, etc.
Now, Brian, when it comes to the data, bulls for the last several weeks have pointed to high-frequency data, things like toll road activity, as points of encouragement for getting involved in these more cyclical parts of the market. But when you think about the trajectory of economies, in particular the U.S. and Europe, how much does that actually tell us? Yes, we are seeing a bounce back in activity, but that should be expected given that we've all been in lockdown for months in some cases. What about the longer-term trajectory? It really doesn't give much insight, does it?
You're absolutely right. So there's been a lot of debate over what shape this recession and recovery will take. For us, really, it's about the pace of recovery. And ultimately, that comes back to how quickly can we get people back in jobs that have been laid off during this crisis. And I think it was very interesting watching Fed Chair Powell's comments on Wednesday. I know he's come in for a lot of criticism, but I actually think he did a reasonably good job in mapping out the type of recovery we'll see. So we will see economic activity bounce back in the second half of this year. As you rightly say, we are seeing that in real-time economic data. We're also seeing some very encouraging signs out of China. So China retail stores, 95% are open again, but sales are only in the region of around 65%. So we don't think we get back to full economic recovery out until 2023. But in the near term, the market's going to take its direction from economies opening up, and any more positive signs on that could see a rotation back into that valuation trade that we recently discussed.
I want to pick you up on that really important point you just made about what we're seeing in China, a return of activity, a reopening of stores and factories, but we're not necessarily seeing this equal bounce back in sales. And we've seen in Europe and in the U.S. savings rates really rocket as people have stayed home for those fortunate enough to continue receiving an income here. Do we have any visibility on whether those higher savings are actually going to translate into higher consumption?
I mean, mean, again, if we look at data out of China, yes, it's going to be a slow, gradual recovery. But even in consumption areas such as autos, which are typically a big ticket item for consumers, auto sales are up almost 2% year over year. As you rightly say, households actually came into this downturn with really healthy balance sheets. We didn't see people overextended as they were in the run-up to the global financial crisis. As we know, governments around the world have written checks to households. The US household saving rate jumped to an all-time record high above 30%. So I think once people get more confident that economies are opening up as they get more security in terms of their job prospects, we will see a lot of pent-up demand bounce back, and ultimately that will be good. But again, it's really about our ability to suppress this COVID curve, and particularly in some of those states in the US that we've spoken about.
And on the point about the U.S. and the trajectory for the further response there, yesterday, Treasury Secretary Mnuchin made very clear when he spoke to our U.S. colleagues that they have no interest, the Trump administration, in shutting down the U.S. economy again, even if we see numbers rise, which we're seeing in parts of the United States. How do you price that in when you're strategizing how to navigate your portfolio? The fact that we may see an uptick in cases, the economy's not going to shut down. How do you actually work with that?
I think it's really important. And actually, while we went through the cyclical rotation through April, I actually think one of the key drivers for that was President Trump's comments, similar to Steve Mnuchin's, that they will not go into full lockdown again. So I think governments around the world now are much better prepared in the eventuality of a second wave, whether it happens during the summer or later this year. So we're likely not to see similar shutdown to economies as we've seen in the past. It's more likely to be along the lines of test, trace, and isolate. And that is absolutely critical in terms of the ability of economies to open up and ultimately for corporate profits to come back.
And Brian, specifically, what sectors are you looking at? What does this all mean for your recommendations?
So a lot of the work we do focuses on the economic cycle. I mean, we've developed some proprietary tools which, gave us the opinion even coming into this year pre-COVID that we were late in the cycle. So, thankfully our portfolios were positioned favorably in terms of dealing with some of the fallout through February and May. So we have a number of strategies implemented across our portfolios, such as high quality, min-vol, utilities, and even healthcare. So that's really provided some stability portfolios. Increasingly on our investment committee now, we are discussing about gradually implementing some more cyclicality into portfolios. I can't say we have the confidence to do that today, but essentially, over the next couple of months, we expect to move to a more barbell strategy, so retain some of the lower beta defensive positions that I've mentioned, but gradually begin to position for an economic recovery. And as we know, the market will start to discount that a long time before we actually see it in hard economic data.
Brian, thank you so much for joining us this morning. I really appreciate your views. Brian O'Reilly, Head of Market Strategy, Mediolanum International Funds. President Trump has attacked the Federal Reserve for the first time in months. Trump took to Twitter to signal his dismay over the central bank's grim economic forecasts following its latest policy meeting, saying the Fed is, quote, wrong so often. He added that the third and fourth quarters will be very good and that the U.S. will see one of its best ever years in 2021. That's contradicting Fed Chair Jerome Powell's outlook. Meanwhile, U.S. Treasury Secretary Steve Mnuchin has told CNBC the American economy cannot afford another shutdown as concerns grow that certain cities are seeing a second wave of the pandemic.
We can't shut down the economy again. I think we've learned that if you shut down the economy, you're going to create more damage, and not just economic damage, but there are other areas, and we've talked about this, of medical problems and everything else that get put on hold. I think it was very prudent what the president did, but I think we've learned a lot.
Well, coming up on Street Science, the UK economy has just been announced that it suffered the worst contraction on record, around about 20% lower in the month of April. That's the worst we've ever seen. But how are businesses, including a magnificent borough market, fighting back in the new world? We'll discuss after the break on Street Science.
Trey Wingo here from ESPN's Golic and Wingo. Every morning, Mike Golic Jr., and I sit down to discuss all the news, drama, and highlights spinning the sports world that day. And with TuneIn, you can hear us whenever and wherever you go. Just search Golic and Wingo and start listening today.
To help keep you and your loved ones safe, TuneIn has the latest guidelines from the CDC. CDC says there are still precautions to prevent the spread of COVID-19. Wash hands often for 20 seconds and encourage others to do the same. Use hand sanitizer with at least 60% alcohol if no soap or water is available. For the latest stories and updates on COVID-19, search Coronavirus News on TuneIn.
Who says you can't have a laugh while getting serious about America's pastime? On the daily podcast Locked On MLB, comedian and baseball fanatic Paul Francis Sullivan talks about each team, each pennant race, and everything else in the game, from rule changes and controversies to baseball cards and stadium food.
For those of you who are not familiar with me or the old show, I love to obsess over baseball. I'm talking baseball over the Super Bowl. We had a TV showing the division series during my wedding.
Search Locked On MLB on TuneIn to listen today.
Hey, Cowboy. Hi, everybody. Good morning. Welcome to Today.
What's your name? My friends call me Beaver.
This is a crate from KiwiCo. Each crate has an awesome science, art, or engineering project inside. Parents can order online and it ships right to your door. Learning has never been so fun or convenient. Get 30% off. Visit trykiwico.com.
I love this photo of my nephew, but getting it from here to here can be a real pain. That's why I started Keepsake, the free app that makes it easy and affordable to have your favorite photos framed. So if you've got a special photo on your phone, download the free Keepsake app and start framing today.
Ownerly.com gives you access to home estimates used by the pros for free. Just go to Ownerly.com, enter the address, and see the home value instantly. Come to Ownerly.com and see what your home is worth for free.
We are KiwiCo, and we deliver hands-on STEM projects designed to inspire young innovators. Kids of all ages can explore science, engineering, art, and more. Get 30% off. Visit trykiwico.com. Must be 18 or older to log on.
On Squawk Box, Elon Musk and Tesla on a tear. The space launch, soaring stock price, raising the stakes for electric vehicles. Inside a company climbing for more. Today, watch or listen live on the CNBC app.
Welcome back to Street Signs. We've got some fresh news out of Air France, and you'll want to listen up if you're trying to plan your summer holiday. Air France has come out saying that they expect to serve close to 150 destinations this summer. That is 80% of its usual network. By the end of June, the flight schedule will represent 20% of the capacity usually deployed over this period. The priority is going to be given to strengthening its domestic networks. Several routes will resume between Paris and the French regions, as well as interregional routes, particularly to and from Corsica. A number of services will also be increased to the French overseas departments and territories, as well as to Europe, mainly to Spain, Greece, Italy, and Portugal. Notably, the UK is absent from that list. Long-haul services, listen up for this, long-haul services with Air France will gradually resume on a large part of the network, both for passenger and cargo transport, which is particularly buoyant. So that's the latest out of Air France. By the end of June, the flight schedule will represent 20% of the capacity usually deployed over this period. So there's some fresh news out of Air France that no doubt will be important for those of you trying to book your flights. A little bit of good news there. Now, sticking with the airlines, British Airways, EasyJet, and Ryanair have launched a legal challenge against the UK government's incoming quarantine rules. In a joint statement, the carriers described the measures as flawed and warned the policy would have a devastating effect on the UK economy. The 14-day quarantine rules are set to come into effect on Monday, but with several exemptions. And in the airline ecosystem, Airbus CEO Guillaume Faure has warned UK staff they may face, quote, more permanent job cuts than their colleagues in France and Germany. Speaking to the Financial Times, Faure said the UK's decision to end its furlough scheme by October could see a more permanent reduction in its workforce. He urged the British government to recommit to the aerospace industry by pledging to protect jobs and wages in the sector over the long term, like France and Germany have done. The UK government will reportedly introduce a light touch regime to border checks after Brexit, abandoning its plans for a rigorous examination of imports. According to the Financial Times, the plans were eased from calls from businesses who were keen to minimize disruption amid the virus pandemic. Economic activity in the United Kingdom suffered its sharpest contraction on record in April, falling 20.4% in the country's first full month in lockdown. The figure was worse than forecast, with the construction sector proving to be the biggest drag on the economy. Well, let's get out to Steve for more on this topic. Steve, we all knew that the damage was going to be severe. Investors now focusing on the reopening of the economy, which is why I think you're standing in front of Borough Market this morning.
Yeah, more about Borough Market in a few moments' time, Juliana. I mean, I know it's a place that you and I both love anyway, and it's a charity, so we can say that without any comeback at all, so to speak. But look, this economy is in dire straits looking backwards. The question is it in dire straits now, and is it in dire straits going forward as well? And we've already heard on Squawk Box this morning how the theatre industry is really going to struggle at the moment with social distancing to get back on track as well. But some of those figures you just mentioned, construction down 43.6%, industrial production down 20.3%, broader economy in April down 20.4%, adding to the 5.8% we lost in March. These are devastating figures as well. But is there going to be longer lasting damage? And is the furlough scheme just delaying the inevitable, especially when we talk about other names, including Airbus, you just mentioned, just in the last 48 hours? What have we heard from? Centrica, we've heard from Johnson Matthey, we've heard from BP this week as well. We've heard from a whole host of companies who are cutting tens of thousands of jobs. So real concern there. And you mentioned the airline industry already today. Heathrow is looking at some potential voluntary redundancies as well. So what can we do to get back this economy? Well, that remains to be seen. But areas such as Borough Market really trying to fight back as well. And I'm delighted to be here. You've got stall holders like Gary and Sam behind me as well. But I'm also delighted to say we've got Darren Hennigan, who is the MD of Borough Market, joining us today. Good morning to you, sir. Good morning. Right, let's set something straight. Borough Market never shut, did it, as well? So how tough has it been?
It's been very, very difficult. We've been able to keep the core of the market open. We've really kind of gone back to our roots as a food market, to sell groceries to local people and the people that come and work. We have Guy's Hospital across the road, so we've done a lot of work with NHS workers to support them as well. And we've been able to come through, but it's very, very, very different now.
What's the footfall down? I think you gave me a figure earlier.
88% down. Yeah. So it's a significant drop, particularly earlier on in the week. At the weekend it builds a little bit, but still nowhere near. Many of your viewers will know how the hustle and bustle of Borough and the amazing cacophony of food is here. That's not quite the same now. It's more of a place to come and buy your groceries and then go home and enjoy them at home.
Yeah, there is a sign. I mean, you've got one here, 2 metres, keep apart, but there's another one very similar. It's like kind of just get your food and get out pretty much along those lines, isn't it?
Well, it is. You know, we have to set a limit on the number of people that can come in so that we can keep social distancing. And that's been tricky, and we need to... The public want to do the right thing, and we need to help them do that and enjoy the space. And that means things like keeping 2 metres apart, but it also means things like queuing outside of the market before you come in sometimes when it's busy, but also doing your bit, getting your stuff, having your shop, take it away and enjoy it at home rather than walking around.
You mentioned the magnificent people of Guy's Hospital. Again, just round the corner, as we know. We're in the shadow of the Shard as well, which would normally be bustling. London Bridge Station, which is just magnificent now. But it's not just about the local people as well. It's about the office workers and it's about the tourists as well. Are they coming back?
Well, what we've seen is a gradual building up, but we are nowhere near what we would normally expect to see. Foreign visitors into Borough Market are normally about 12% of our visitors, but that's still over 1.5 million people a year. That's more, for example, than the whole of Wales gets. So missing those people has changed the nature of the trade as well as changed the volume of the trade. So traders were set up for one thing and they needed to pivot to something very, very different so that they can survive. So businesses that were previously selling hot food to tourists are now selling fruit and veg to people to go and experience at home.
What about the relationship with the government as well? I mean, I mentioned earlier on you're a charity, but obviously you still want all your stall holders to make as much money as possible because it is a fantastic part of the community. I'll say that unashamedly as well. government, the mayor, the local council, good and bad?
Well, I think what's happened is it's been a challenge that is unprecedented in history everywhere in the world. And I think the government, in the main, has stepped up to the plate. We're a little bit concerned about the way in which we come out of lockdown as much as the way we went into lockdown. We could understand, really, the way in which things moved away. But the way in which we're emerging is a little bit sudden and jerky and sporadic. And for us to be able to set up and be ready to handle people safely needs a little bit more time, a little bit more discussion before it just suddenly gets announced.
You see your frustration because we don't know whether 1 metre is going to be in or not, or whether it's going to be stay at 2 metre, and you've got to work around that. We don't know if the British tourists are going to have 14 days quarantine or not as well. So what policy could make the biggest difference to the medium term for this business?
I think we need to look at the way in which we can operate these places safely into the longer term. This isn't going away quickly. There is no whistle that's going to be blown and we suddenly all go back to normal. So we need more support, more communication of how spaces can operate. We have restaurants all around us, and those restaurants are on their knees because they are just not able to trade at all. And selling a few, ice creams or a couple of pizzas out of a window is not the same as proper restaurant. And those people need clarity as much as anything else.
Sharon, I make no bones about it. I'm one of the biggest food bores on the planet since I started learning about it, and really I'm trying to understand what I eat as well. You, if I may say so, you were born on a Staffordshire farm, or you were part of a beef farm in Staffordshire as a young man as well. You understand food as well. There are trends happening which are magnificently shown here, but there are other trends you must be worried about, i.e. food that could come into the country that perhaps hasn't got the same kind of standards. Are you worried about Brexit and trade deals going forward?
Well, I think the thought that Brexit is done is a complete misnomer. In a way, the easy bit was going out of the EU. The difficult bit is what we then put in its place. And in some ways, there's great opportunities for the UK to have a proper food policy, a proper sustainable approach to what we eat and diet and variety and the quality of food. Of course, we're concerned that if we don't get the safeguards around quality, that we'll have an unlevel playing field, but also, if it's not clear on the packaging what people are buying, the quality food will be sitting next to food which has maybe been imported, which isn't the same quality, and that will be a real detriment to trade here and trade throughout the United Kingdom.
One cheeky last question. I'm going to put my hand in my pocket in Borough Market today. Where shall I go?
I'll go to the fish counter. It is superb. Absolutely superb.
All right, fantastic. Thank you very much indeed.
Thank
unashamedly, thanks Darren Hennigan, who is the MD of Borough Market, unashamedly, to every one of our viewers who's in the environ of the City of London today, come down here, put your hand in your pocket and spend some money in Borough Market. Not only will you get some great grub, but it's also a charity. And Juliana, I know that you are a big fan as much as me. Back to you.
Definitely. I wish you could have stopped by the studio afterwards and bring us some of that fish. Thank you so much, Steve, for bringing us that interview. Coming up on this show, Swiss exchange group SIX joins the big league of European bourses after sealing a deal to buy Spanish rival BME.
The right time with Bomani Jones.
While he was gone, Al had some kind of vote to make him the managing. You remember he used to come up all the time in the Raiders game that he was the managing general partner. By the way, and don't forget, there was a lot going on in Munich. But you know how tired that man was to come back and find out that Al Davis had strong-armed his team from him while he was gone?
Search The Right Time with Bomani Jones to listen.
And book your round today. Golf Now. Go play.
Power outages can be unpredictable, inconvenient, and disruptive to your life, posing a real threat to your comfort and safety. When the power goes out, you have no lights, no refrigeration, no heating or air conditioning. Your well or sump pump won't work. Your modern daily electronics are rendered useless. And what if the power's out for days or weeks? Are you prepared? You can be with a Generac home standby generator.
24 days we were without power. I had water, I had ice, I had coffee, I had air conditioner. I was able to stay here because of Generac.
When an outage occurs, your Generac home standby generator automatically powers up, so your life goes on without disruption. You and your family are comfortable, safe, and secure. Generac generators run on your home's existing natural gas or propane. And Generac's standard Mobile Link remote monitoring system keeps you posted on operating status, maintenance updates, and more. Generac generators are designed, engineered, and purpose-built in the USA. Generac is the #1 manufacturer of home standby generators in the world. 8 out of 10 home generators are Generac, with thousands of satisfied customers.
Very good product. Very, very good reviews from everybody.
Prices start at just $19.99, and special financing is available with surprisingly affordable monthly payments. Call now to schedule your free in-home assessment with one of Generac's 6,000 nationwide dealers. The call is free, the assessment is free, and there's no obligation to buy. Plus, if you act now, you'll receive a 7-year extended warranty absolutely free. That's a $695 value. Call now, so the next time there's a power outage, your home powers up. Power your life with Generac. Call or go online to schedule your free in-home assessment today.
On Squawk Alley, breaking the cycle, what companies are doing now to diversify and bridge the divide.
Then is anything going to change?
NBC app.
The station you're listening to is experiencing technical difficulties.
Welcome back to Street Signs, everybody. I'm Juliana Tattlebaum, and these are your headlines. European markets move further into the green as U.S. futures bounce back from Wall Street's biggest sell-off since the middle of March. Launching legal action. UK airlines challenge the British government's 14-day quarantine rule, asking the courts to consider their case as soon as possible. The UK suffers the sharpest monthly contraction on record as GDP falls by more than 20% in April, in the country's first full month of lockdown. And the SIX Group seals the deal with the BME after the Spanish exchange's shareholders overwhelmingly back the near $3 billion takeover. I'll speak with SIX Group CEO Jos Dijsselhoff in just a couple minutes. European markets have now been trading for about an hour and a half, and after starting the day on the back foot in negative territory, we've now seen a march higher, and the gains have accelerated in the last half an hour or so. We're now looking at about 80 basis points higher for the DAX. The CAC 40 is leading the charge higher, up about 1.25%. Also gains on the Italian and UK markets. And the sell-off yesterday was to the tune of more than 4% for the overall European index. Let's put this into context. Last week, several markets here in Europe gained more than 10%. So the sell-off that we've seen this week has really just been a retracement of some of the gains that we saw last week. But clearly investors now pausing, trying to decide what comes next for markets, what's going to be the next catalyst. Now that the Fed meeting is out of the way, we know that they are keen to hold rates steady until 2022, steady near zero. We're now eyeing very closely infection numbers and hospitalizations in the United States, in particular in the Deep South and on the West Coast. Let's take a look at FX markets. Yesterday, we saw the dollar index actually gain nearly 1%. We saw that real demand come through for safe havens. We saw demand for treasuries, and that was as money came out of the riskier parts of the stock market. Now this morning, we're seeing a renewed appetite for sterling and the euro, trading about 20 basis points and 30 basis points higher, respectively. We've also got a little bit of Brexit headlines to digest. We are looking at a long-awaited high-level talks kicking off between the EU and the UK on Monday, so we're expect more headlines that may affect sterling in the days and weeks ahead. The dollar trading slightly firmer versus the yen, up about 30 basis points to the 107 mark. Let's get a check on oil markets. Amid the sell-off in stock markets yesterday, we also saw oil prices plunge by about 7-8%. Now we're looking at a little bit more pain for the oil price. Brent trading down about 1.25%. WTI trading down about 1.5%, around the $36 a barrel mark. And let's get a check on Wall Street, where we're poised to open. We've got green across the board there. The Dow looking at about a 500-point rise at the open if these levels hold. They have been bouncing around a little bit, so we'll see. It's still a long way to go between now and the Wall Street open. The NASDAQ and the S&P also pointing to a stronger start. Now, the market sell-off has raised fresh concerns over the valuations of stocks. At least two of CNBC's well-known guests sounded pessimistic about current levels.
if the stocks are trading at 30, maybe 35 times earnings, that yes, it's a bubble. I mean, those sorts of valuations are really historically extreme, and in all likelihood, end in tears.
Markets always overshoot. We probably overshot on the downside, and we probably overshot on the upside. So if you look at where we are right now, we've come back down around 8% or so from the highs, but we're still up over 35% for the lows. We're in the period where we're trying to find a relative fair value for equity. That doesn't mean they can't go lower, and it doesn't mean they can't go higher. We're trying to digest right now what value should be.
Euronext has announced that Teleperformance will enter into France's CAC 40 on June 22nd as part of a reshuffling of the index. The call center specialist will replace catering giant Sodexo, which has seen its share price slide during the coronavirus pandemic. Speaking to CNBC earlier this morning, Teleperformance CEO Daniel Julien said the company was quick to adapt to the outbreak.
Some of our big clients have been touched, and very much, specifically in the hotel industry or in the airline companies, and the business has gone down. Some of our clients, on the other hand, specifically in the e-economy, have seen their activity boosting. But what was critical in this crisis for us was agility, which was the ability to convert our brick and mortar call center into remote work.
We've got some deal news for you. Swiss exchange group SIX has leapfrogged into the top 3 League of European bourses after completing the takeover of Spanish rival BME. The 2.6 billion euro deal marks SIX's expansion into the European Union. It also ends the independence of the Madrid Borsa, which was founded nearly 200 years ago. Josse Dijsselhoff, the CEO of SIX Group, joins us now. Really great to have you on the show, sir, and congratulations on consummating this deal. I want to kick off with your strategy from here. Clearly, this industry, the exchanges, has been under a lot of pressure over the last few years, struggling with lower fees, declining revenues. What is your plan from here? Are you inclined to go down the path of, becoming more of a fintech conglomerate? Are you interested in payments? Are you interested in strengthening your exchanges business? What's the story?
Hi, Juliana. Thank you for having me. It's really exciting that we are now in a position to confirm the BME transaction with such a high percentage of acceptance from the BME shareholders, which I think is a great testament that the combination of BME and SIX will be very strong. As you know, SIX has 3 different business lines: payments, data business, and the stock exchange. Payments is very local in Switzerland, but the data business is a very international business where in the areas where we're very strong, we're competing with Reuters, Bloomberg, and Refinitiv. And on the stock exchange, we now made a big move to become even bigger and get more scale in Europe, in the EU, and in Switzerland together with the combination of BME and SIX. And we will use that platform around payments, around data, and the stock exchange to further build out our business. And to your point, we will invest also heavily, and we are investing heavily in new technology and innovation. So next to building out the existing business, creating more scale, delivering more products and services to the customers of both BME and SIX, we will also continue to invest in new technologies and business and services.
So does that mean that you would be looking to add more verticals or continue to strengthen your payments or exchanges businesses?
I think with the combination of SIX and BME now, we have 2 strong verticals in 2 strong home markets combined, which gives us a very good position both in Switzerland and in the EU, where Spain will be the beachfront for the beachhead for EU expansion. So from that perspective, I think we're sitting quite well. We will, of course, always look at opportunities for the exchange business also going forward. But one of the key priorities will also be the data business, which we see as a huge opportunity to grow. And next to that, the payments business, what we see is that more and more customers are looking for integration and more combination and cross-pollination of products and services across data, across payments, across across the exchange business. So we will definitely look at that and continue to invest in all three businesses.
Right, a huge theme for this industry. And I'm curious, you talk about how you've strengthened your data business, and clearly your infrastructure offering very competitive with your peers. How do you expect the LSE Refinitiv deal to affect the competitive landscape when it comes to these more integrated businesses?
I think I understand the strategy of LSE, to be honest. I think a pure exchange business needs to be complemented with data. We even have the payments business also in our portfolio. So I see that as a good move for them. But we already have that portfolio. We will be investing in trying to get more data, alternative data and other data sources into our portfolio, deliver that data in a smarter, more effective and flexible way to our customers using cloud, APIs and these kind of things. And then on top of that, we will further build out our analytics and other capabilities to provide from the data that we have and the data sets that we have directly insight for our customers. So really moving up to the value chain. And that data business is something which I think is a huge opportunity combined with the exchange and the payments business to drive our business forward. And we're very excited about investing and further building that out also.
If I could shift gears a little bit and talk about the impact that COVID-19 has had on the industry. Clearly, from a market volatility perspective, this could offer a boost for the exchanges. We heard from Credit Suisse CEO earlier this week talking about the uptick in capital markets activity, which should be a tailwind for a business like yours. But if you can weigh in on that, that'd be great. But perhaps longer term, do you see COVID-19 leading to any structural changes within your industry?
I think COVID-19 will create some structural changes to the way people live their lives, to say it very broadly, and might also make some changes to the financial industry, although I think that impact will be less big. Of course, we've seen tremendous volume in the last couple of months, and we will continue, I think, to see good volumes on the markets. There's volatility, there's interest. We also saw the first IPO of the season on the SIX exchange today. So also that season is now starting, and there will be more IPOs very likely following this year. So from that perspective, I see a positive landscape in the medium term. In the long term, of course, if companies are struggling to be profitable, if companies are struggling to deliver on their targets, that might impact share prices and might impact, let's say, longer-term sustainable future of some of those companies, and that will then also impact, in the end, the financial markets, of course. So for short-term, medium-term, I'm quite positive. I do hope that many companies are able to survive this difficult period and get their business either in an adjusted way or in the way it was before, back up and running. And then it could be a blip, but if there are sustainable dents in certain parts of the economy, then there will be a longer-term impact.
And just lastly, rounding out the conversation around this deal, the news today about consummating this deal with BME, what more detail can you give us around synergies, where the savings are going to come from, and what you're going to do with those savings?
Yeah, we of course we will look also to savings, and wherever there's duplication or wherever there are platforms where we think we can provide both markets with the service from one platform, we will look into that. But the real game of this deal is then to reinvest those savings and reinvest our earnings into new products and services. And we're really looking at bringing products and services that BME has that we don't have on the SIX side to our customers there, and the other way around. So really cross-sell those services across the two markets. Bringing in the data business and the payments business also into the Spanish geography. And then look at our global landscape in Latin America and Asia, where SIX has strong ties, to further build that out. So it is really a growth story. It's combining two forces, creating a more efficient platform, and invest that into building out our business.
All right, Joost, really appreciate you being with us. Joost Dijsselhoff, CEO of SIX Group. And as a reminder, you can follow us on Twitter at StreetScienceCNBC. You can also tweet me directly at CNBC. Juliana, I always love to hear from you. Coming up on the show, pressure mounts on corporations to take tangible action in the wake of global protests of racial inequality.
we're told that masks don't work. Then we're told to wear them all the time. One week, we hear that the mortality rate is 2%. The next, well, who knows? In the time of COVID-19, there is so much uncertainty, and so much scientists are learning in real time, along with the rest of the world. So it's hard to know what you can be sure of and what's still a big question mark. Enter Podcast 19 from 538, where we'll explore the evidence behind the science in our fight against coronavirus. I'm science journalist Anna Rothschild. Each week, I'll investigate coronavirus mysteries, keep track of the latest developments on vaccines and treatments. Oh, and I'll try to edit out all the times I shush my family since I'm recording this thing from the chaos of my home.
Search Podcast 19 to listen today.
Beautiful.
At Tommy John, we believe you deserve the most comfortable underwear. And breathable, supportive, lightweight stretch fabrics for the perfect fit on every guy. We believe in can't believe they never thought of that designs, like our Stay Put waistband and the horizontal quick draw fly. We believe the daily grind should only be in your coffee cup, not in your underwear. Plus, we guarantee no wedgies, no adjustment needed. Feeling is believing. So upgrade now and get 25% off site-wide at TommyJohn.com.
Nick Bolton here with the latest from Bell & Howell. We call it Tac Visor. Tac Visor can do things no ordinary visor can do. Like block blinding glare without blocking your view. So invisible dangers suddenly become visible. And enhance colors to give you vision as sharp as an eagle's. The secret is Bell & Howell's light filtering technology. Look at that windshield. Tell me what you see. A blank screen? Just a blank screen. Go and put down that Tac Visor and take a look again. Wow, what the? That's crazy. Best of all, Tac Visor is easy to install in any car.
Act now to get a Tac Visor for just $19.99, and we'll even ship it to you free. But wait, order today and we'll upgrade you to our 2-in-1 Tac Visor. Just pay a separate fee. When the sun goes down, use the night vision visor to improve visibility and block dangerous glare from oncoming headlights. Here's how to order.
To order, call 1-800-825-9775. Again, that's 1-800-825-9775, or order online at tacvisor.com.
States of Play, CNBC and Change Research's exclusive survey. How the virus and economic crisis is impacting the critical swing states that'll decide the election. Special reports all week and on CNBC.com.
U.S. President Trump says he's finalizing an executive order in the face of nationwide protests after the death of George Floyd. The president wants to invest in police, opposing calls to defund the force, and promised a directive that would upgrade policing standards.
We're doing it with compassion. If you think about it, we're dominating the street with compassion because we're saving lives and we're saving businesses. We're saving families from being wiped out after working hard for 20 and 30 years.
Meanwhile, the majority of Americans support sweeping law enforcement reforms, according to a Reuters Ipsos opinion poll. It found that 82% of respondents want to ban chokeholds, 83% are in favor of getting rid of racial profiling, and 92% want police to be required to wear body cameras. $2.6 million a day. That's what the deployment of thousands of National Guard troops to Washington, D.C. cost the U.S. taxpayer. The military mobilization was strongly backed by President Trump in response to protests in the nation's capital. A Reuters analysis of National Guard data showed that the one-week deployment of over 5,000 troops cost about $14.5 million. Let's get into some of the corporate response to what's been going on across America. Snap CEO Evan Spiegel has defended the company's decision to restrict President Trump's account, telling CNBC in an exclusive interview that it is within the company's First Amendment rights. This after Snap announced last week it would no longer promote the president's content within Snapchat's Discovery feature.
I don't think there's been too much blowback. You know, we've always said Discover is a closed platform and we choose the types of content we want to promote on our platform. So we're well within our First Amendment rights to decide what shows up on there. And, you know, in terms of our business and our community, we're very focused on our values and expressing our values through the things that we promote on Snapchat. So I think it was a relatively easy and straightforward decision, and we'll continue to try to create a Discover experience that reflects our values and promotes the types of content that we think are important for our community to see.
Microsoft says it will not sell its facial recognition technology to police, just a day after Amazon announced similar action. The tech giant doesn't currently sell its products to police departments, and Microsoft President Brad Smith said that it won't until a national law is in place that, quote, grounded in human rights and governs its use. He also added that it is not just up to tech companies to act, calling on Congress to take action as well. Apple CEO Tim Cook says he'll spend $100 million on a new company initiative dedicated to racial justice. The effort will focus on issues surrounding education, economic equality, and criminal justice reform. To watch Cook's announcement and learn more about the initiative, head to CNBC.com. Now, Apple is just one of many U.S. firms taking action following the global Black Lives Matter protests. Alphabet has started a $100 million fund to develop the voices of Black creators. Similarly, Bank of America has also launched a financial campaign, and IBM, like Microsoft, has announced it will no longer sell facial recognition technology to police. Let's bring in Serena Abbasi, who is going to talk more about diversity in the workplace for us. She's worldwide head of culture and inclusion at MC Saatchi. Serena, thank you very much for joining us from Bristol. So just not far from where we are in the London studio, really reflective, I guess, of how widely the Black Lives Matter protests have spread. I want to pick up on something that you've written recently around demographics and how demographic shifts are calling for us to have inequality and racism right at the heart of corporate culture. What do you mean by that?
Yeah, so hello everyone. So yes, what I mean is, in the UK, for instance, the mixed race is the fastest growing race in this country. And with that in mind, I think there needs to be greater visibility of all the different types of demographics that represent the British people within corporations. But also we need to shift, as our, an organization is only a microcosm for society, right? So we need to be mirroring all the different shifts that are happening throughout our society in business.
Serena, it's Karen here, just jumping in. I know as soon as the last few months, you were a little bit frustrated by the pace of change for many corporates about truly embracing diversity. But what we've now seen on the back of the killing of George Floyd has been corporates coming up with very strong external messages. When they haven't, they've been condemned. You've seen more financial money committed to the cause of change, and also many internal memos issued to employees about change. Do you think this time is different?
I think this time will be different because, as we know, I think the landscape that we're in with the pandemic has given people the bandwidth to really engage with subjects that they weren't, to be quite frank, weren't that engaged with before. I think a lot of people are reprioritizing, and as we probably know, up until the elections in November, Trump elections, the American elections, we will definitely see protests, I imagine, all the way till then. So I think this is definitely going to be front and center of people's minds for quite some time.
Can I ask you about what managers need to do at this stage? Because many find themselves in uncomfortable territory. They want to bring about change, but they don't know exactly what to do, what sort of change to ensure across their organization to bring a change in culture. What do you suggest at this point?
I would suggest this needs to be a listening exercise for businesses, and in regards to kind of external corporate responsibility and internal responsibility for your people. I think first and foremost, corporates need to be working internally. What's their internal culture like? Are they listening to all the different voices that make them who they are? Do they have representation of Black and brown people at senior leadership level? And if not, how can we facilitate spaces where the price of them actually putting their hands up to air a grievance isn't going to cost them their job? So I think it takes a lot of listening. I think it takes a huge amount of compassion. I think corporations, I'm not even going to use the word corporations. People need to realize that for many people that are marginalized, to see someone that literally could be your relative be killed, murdered in front of you felt so incredibly personal. The way it affected me, I honestly felt like I had seen one of my relatives be killed. It was awful. And I just think a huge amount of compassionate leave needs to be granted to your black staff if they want to take it. And I think that's where it starts. It's about actually humanizing the workplace, because I think there is an absence of humanity.
Right. Serena, in that case, as you use the word personal, how personal do campaigns need to get? I mean, Nike certainly did it with Colin Kaepernick, but others like Adidas only just retweeting messages from rivals. Just how personal should companies get?
I think there has to be authenticity, and I think that's what consumers are calling upon. I think, our history has, there haven't been full truths. If I were to literally, I know I'm jumping slightly, but if I were to just talk about what's been going on in Bristol with Colston, Edward Colston, the statue that was taken down of the former slave trader, there's a real divide. On the whole, Bristol is pro that needed to happen, but there's a real divide still in parts. And actually, most people don't know the West's colonial history, particularly, I would say, in Europe, because obviously colonization happened out of sight. It happened in the colonies, where in the US, the brutality of it was literally on people's doorsteps.
I'm afraid we're going to have to leave it there, but we've got plenty more conversation on this topic in the future. Thank you for weighing in. Serena Abbasi, Worldwide Head of Culture and Inclusion, MC Saatchi. And we'll leave you with a look at U.S. futures. We are poised for a bounce at the open, nearly 600 points for the Dow Jones. That's it for today's show. I'm Juliana Tatelbaum, Worldwide Exchange. Up next.
Introducing a new podcast, ESPN Daily, hosted by me, Mina Kimes. When you want to go beyond your feed, when you want to get inside the score, when you want to get behind the highlight, there's ESPN Daily. Go deeper into the stories of the moment. Get the exclusive access and insider perspective that only ESPN can give you. The best sports story all day, 20 minutes a day, 5 days a week. ESPN Daily.
Search ESPN Daily to listen.
PowerCell's revolutionary technology captures and stores electricity either from solar panels or the electrical grid. It allows you to use stored energy during peak demand times when electricity costs are high, which helps reduce your electric bill, saving you money. And when a power outage occurs, PowerCell is ready to supply backup power to your home. PowerCell's modular design allows for easy customization for any home or budget. And PowerCell is backed with a 10-year limited warranty.
It was a simple installation, very neatly installed. It was done very quickly and efficiently. Since installing our power system, we've been experiencing a savings of $1,500 a year.
Generac has been a trusted provider of backup power solutions since 1959 and provides 24/7 customer support.
The battery storage solution in combination with the solar has been one of the best investments we've ever made.
Special financing is available with low monthly payment options. You will likely qualify for tax credits and energy rebates, which could save you up to 30%, adding to the savings you'll enjoy over time with PowerCell. Call now to schedule a free in-home assessment. The call is free, the assessment is free, and there's no obligation to buy. Act now to receive PowerView, Generac's home energy monitoring system, a $300 value. With PowerView, easily keep tabs on your energy consumption, monitor your battery usage, and track your savings. Don't wait. Call or go online now. PowerCell, savings powered by the sun.
Meet Gravity, the original weighted blanket for sleep, stress, and anxiety. Gravity is the only weighted blanket demonstrated to improve sleep and reduce stress. Now available in cooling for summer.
Have you heard? Home Chef is the only leading meal kit with oven-ready meals. And with new menu options available each week, Oven Ready is a deliciously simple dinner solution you've got to try. Want to hear more? Every Oven Ready meal arrives with pre-chopped ingredients in a ready-to-cook tin that makes cooking and cleanup easy. So say goodbye to cleanup duty and hello to Oven Ready meals. And new recipes every week. Get $30 off your first month at homechef.com. Home Chef, delicious meat simple.
This is a crate from KiwiCo. Each crate has an awesome science, art, or engineering project inside. Parents can order online and it ships right to your door. Learning has never been so fun or convenient. Get 30% off. Visit trykiwico.com.
On Squawk Box, Elon Musk and Tesla on a tear. The space launch, soaring stock price, raising the stakes for electric vehicles. Inside a company climbing for more. Today, watch or listen live on the CNBC app.
In an era where we're afraid to touch cash or hand over our credit cards or type on a potentially COVID-encrusted keypad, Shatter, Apple's Pay's contactless technology has become a necessity. Honestly, watch or listen live on the CNBC app.
Breaking news. Global markets hammered after Wall Street saw its single worst session since mid-March. The Dow plunging more than 1,800 points in one day. Investors on edge over upticks in positive coronavirus cases and hospitalizations in many states pushing to reopen their doors for business. The White House says the economy will not go into lockdown again. Amid the turmoil, one company testing the waters in what could be the largest IPO of the year. It is Friday, June 12th, 2020, and you are watching Worldwide Exchange right here on CNBC. Good morning and welcome to the show. I'm Dominic Chu in for Brian Sullivan today, and with me for the entire hour is Ally Invest Chief Investment Strategist Lindsay Bell. She is also a CNBC contributor. Thank you very much for joining us, Lindsay. We'll get to you in just a moment. We begin, though, this morning with breaking news as U.S. stock futures look to open sharply higher after a very rocky day for Wall Street. The Dow falling more than 1,800 points to log its worst single session since March 16th, when it fell nearly 13%. Now, you can see here with the time lapse, those moves happened predominantly throughout the course of the day, but then picked up into the closing bell. The Dow is now down more than 7% at this stage. The S&P is down nearly 6%, and the NASDAQ is down some 3%. All are on track to snap 3-week winning streaks, as you can see here, those major averages just this week alone. Amid the sell-off yesterday, we continue to watch technology. Names like Microsoft, Facebook, Apple, Amazon, Alphabet, all closing sharply lower, shedding more than, get this, $269 billion in combined market value. We also want to bring attention to this particular chart. This is the NASDAQ 100 ETF versus the Russell 2000 small cap ETF. You can see here we saw some of that reopening positivity for small cap stocks over the course of the better part of the last couple of weeks. And then we've seen all of that negativity come right back. So this has been a semi-rotation, a mini rotation into economically sensitive, economy reopening type names in small caps, and now again some underperformance there as well. It's a trade that we're going to watch specifically, see if it plays out again in today's session. Now, around the world, we've got red arrows in Asia overnight and a very mixed picture thus far in Europe. Matt Taylor is standing by in Singapore. Juliana Tattlebaum is in our London newsroom. And Matt, we will begin with you.
Yeah, hi there, Dom. Red arrows, but things certainly didn't end up as bad as they could have. We did see a big turnaround for Asian markets throughout the course of the session this Friday. Of course, when markets open, we did see sizable declines in the order of 3 and 4%. But if you have a look at the closing numbers, markets really closing well and truly off the lows of the day. The South Korean market faring the worst, dragged down by tech stocks there. But China markets faring the best. The Shanghai Composite essentially ending flat. Hopes for capital reforms on the mainland helping out the market there. In Hong Kong, we closed down by less than 1%. Travel stocks hit again. Cathay Pacific again reiterating it expects a substantial loss over the first half of the year, following on from this week's bailout from the government in Hong Kong. The Japanese market was a big turnaround story. We were down by about 3% at one point, but the market closing down only by about 0.75%. We saw money flowing out of the Japanese yen. It had gone into the yen during your session, of course, as that safety play, but we saw money coming out of the Japanese yen that supported the Tokyo market. And the Australian market also down sharply as well, off by about 2%. It was down by more than 3% at one point, so recovering some of those declines. But the Prime Minister there saying he expects a broad reopening of the Australian economy across state borders by July. So that did help support the market there. Dom, back to you.
All right, Matt Taylor, have a nice weekend. Thank you very much. To the early trade now in Europe, Julie Juliana Tattlebaum is standing by in our London newsroom with the latest there. Good morning, Juliana.
Dom, good morning. Well, let me tell you, European markets have been open for just about 2 hours, but it feels like a lot longer than that. We opened in negative territory, the Stock 600 extending the sharp losses that we saw yesterday, but now we have firmly bounced into positive territory. As you can see here, all 4 of these major regions in Europe are trading higher, around 1% or more. The German index, the DAX, up about 1.02% at the moment. The CAC 40, the French market, is leading the way higher, up about 1.6%. This comes after steep losses yesterday where the overall index, the main benchmark, the Stock 600, dropped more than 4%, its worst daily performance since March 23rd. But clearly investors now pausing for breath, trying to determine where the markets go from here. Let's take a look at the sector breakdown. Much like you've seen in the U.S., we had seen this trade building over the last couple of weeks, a shift out of the growth, defensive parts of the market into more value, cyclical parts of the market. That trade has begun unwinding. Now this morning, we're seeing a renewed bid for those stocks. So autos, travel and leisure, and banks are performing best. On the downside, we've got healthcare, the only sector in negative territory at the moment, down about 0.3%, one of the more defensive baskets of stocks in the market. So a little bit of optimism coming back into the European trading session. Dom, back to you.
All right, thank you very much, Juliana Tattlebaum, live in London there. Amid the sell-off yesterday, a major bearish call made on this network by Guggenheim Chief Global Investment Officer Scott Minerd. He says the stock market is a bubble that will likely end in a few tears.
I honestly think that we probably go back and retest the lows, and history shows us that it's very likely that we'll undercut the lows and get to levels that I've talked about before, which are maybe as low as 1,600 on the S&P.
All right. Joining me now, Payne Capital Management President Ryan Payne, and with us for the entire hour is Lindsay Bell from Ally Invest. Ryan, we will begin with you first here. Let's talk about Scott Minerd's comments here. We think the worst is behind us, but others like Scott feel as though we will retest the lows. What exactly is the outlook in your opinion?
I'm relatively bullish here. I just think the bottom line is, look, we just had the 50 best trading days ever in the history of the stock market. And you're going to get some profit taking along the way. And I think that's what you saw yesterday. And that probably added to a little bit of panic selling as well. But the bottom line is, look, you have more government stimulus around the world than we've ever seen before. And the bottom line is the economies around the world are getting better. You start looking at China's PMI numbers, they're going up again. Their demand for industrial metals is going up. So I think all the market really cares about long term is things are getting better, getting worse. And they're clearly getting better right now. And I'm hard pressed to think that we're going to go back to the lows. It's a pretty aggressive statement from where I'm standing, Dominic.
All right. So Lindsay, I'm curious then. There's a reason why markets reacted the way that they did yesterday. No doubt it's been a sharp run higher. But what exactly was the precipitating or factor that really caused the market to sell off as sharply as it did yesterday?
I think it was a couple of different things. Of course, the case count increasing in certain states played into a factor into that, and that's been happening for over a week now. So the market finally took notice of that. The Fed, obviously, the day before coming out while still being dovish. The outlook remains pretty bleak. And so I think it was just really it's just a reality check for the market yesterday. We did, like Ryan said, we came very far, very fast, up 13% in the last month. And the market just started to feel a little bit more frothy. I think if you look at some of the internal indicators like breadth and others, you started to see that the market felt like it was getting a little bit stretched. Today, though, you see the market popping significantly, at least here in the pre-market. You never know what's going to happen throughout the day. But I think what it tells you is that there is still a decent amount of uncertainty in the market. So volatility has returned in a way. And I think it's something that we're going to continue to see until we at least get more economic data and get to second quarter earnings season in July.
All right. So Lindsay, let me follow up with that with you right now. So Lindsay, if that's the case, then what exactly is going to be the biggest factor that affects the future direction of this market? Is it the COVID-19 hospitalizations and infections count? Is it earnings momentum? What exactly does drive the rest of the market for the next 6 months?
Look, I think the market's going to be choppy, at least from here until, like I said, probably until second quarter earnings season. And so I think that the market could react to different headlines as we get them. But I really think that the technicals are once again taking over here. You saw over the course of the past month, the hope for a reopening really driving that upside in the market. And now I think we're getting back to technicals driving the market because we're going to have limited amount of data points and we're going to have limited information coming our way. So the market's going to look towards technicals. It looks like the market's sticking with and around the 200 moving day average on the S&P 500, which is 30.13. After that, 29.55. That's the level where we were at through much of April and May. That could be a level of support going forward. But ultimately, I do think there's enough support in this market from the Fed to support levels where we're at least near today.
All right, so Ryan, let's turn to you for the shopping list. What exactly then? We've had a pullback. Stocks are relatively on sale from where they were about a week ago. Tell us what exactly you would be looking to buy given what we've seen right now.
Yeah, absolutely, Dominic. And I think first off, you want to look at this as a correction in a bull market, right? You're going to hear a lot of the headlines right now talking about how finally the market's coming back to reality with the economy. And I would say don't do that. This is a great time to buy because you don't get these opportunities very often. And you just talked about cyclicals, and cyclicals have had a great bounce off the bottom here. If you start looking at things like consumer discretionary, materials, energy's had the biggest bounce of any sector off the bottom, dramatically outperforming technology here. So I think you would really want to start to buy the stuff that's been beat down a lot. And you talked about small caps. Well, small caps typically outperform when you're in a recovery. So I'm an asset allocator for our clients. We're trying not to put everything into big tech, which is really getting overvalued. I mean, Amazon now trades at 100 times forward earnings. It's getting like crazy. So I think it's really important that you start to spread that money out. International looks good as well. You're getting valuations there. They're very, very attractive. So my shopping list has all the beaten down sectors and all the asset classes that haven't performed well but are starting to perform better since we bottomed back on March 23rd.
Gotcha. All right, Ryan Payne, thank you very much for your thoughts on the market. We appreciate it. And of course, Lindsay Bell, you're sticking around for the hour. Now, when we come back on the show, much more on the market turmoil as stock futures look to try and erase at least some of yesterday's outsized losses. Here's just a few of the Dow names looking to make a comeback in the pre-market so far today. You can see there Boeing adding 7% right now, ExxonMobil adding about 4.5%. Plus, amid the sell-off, one company reportedly looking to dip its toe into the public equity markets in what could be the biggest U.S. IPO of the year. Our own Leslie Picker has all the stuff that you need to know about that particular IPO. And then later on, FundStrat's Tom Lee on the market action and what he's telling his clients. But first, check out some of the other top stories we are watching this morning. Hertz proposing a $1 billion stock sale amid an unusual rally in its shares in recent weeks. Lululemon shares sinking after its sales fell 17% in its most recent quarter. And then Zoom Video looking to limit Chinese government data requests. A very busy hour still ahead when Worldwide Exchange returns after this break.
Can I find an investment firm with a truly long-term view that's been through multiple market cycles for over 85 years? With Capital Group, I can. Talk to your financial professional or consultant for investment risks and information.
Jimmy's gotten used to his whole room smelling like sweaty odors. Yep, he's gone nose blind. He thinks it smells fine, but his mom smells this. Luckily for all your hard-to-wash fabrics, there's Febreze Fabric Refresher. Febreze doesn't just mask, it eliminates odors you've gone nose blind to. And try Febreze Unstoppables for fabric. With up to twice the fresh scent power, you'll want to try it again, and maybe just one more time. Indulge in irresistible freshness. Febreze Unstoppables. Breathe happy.
On Squawk Box, Elon Musk and Tesla on a tear. The space launch, soaring stock price, raising the stakes for electric vehicles. Inside a company climbing for more. Today, watch or listen live on the CNBC app. on Squawk Alley, breaking the cycle, what companies are doing now to diversify and bridge the divide.
Then is anything going to change?
Corporate Insight Smart Solutions. Squawk Alley, 11 a.m. Eastern. Watch and listen live on the CNBC app.
Nick Bolton here with the latest from Bell & Howell. We call it TAC-Visor. TAC-Visor can do things no ordinary visor can do. Like block blinding glare without blocking your view. So invisible dangers suddenly become visible. And enhance colors to give you vision as sharp as an eagle's. The secret is Bell & Howell's light filtering technology. Look at that windshield. Tell me what you see. A blank screen? Just a blank screen. Go ahead, put down the TAC-Visor and take a look again. Wow, what the? That's crazy. Best of all, TAC-Visor is easy to install in any car.
Act now to get a TAC-Visor for just $19.99, and we'll even ship it to you free. But wait, order today and we'll upgrade you to our 2-in-1 TAC-Visor. Just pay a separate fee. When the sun goes down, use the night vision visor to improve visibility and block dangerous glare from oncoming headlights. Here's how to order.
To order, call 1-800-825-9775. Again, that's 1-800-825-9775, or order online at TACvisor.com.
Welcome back to the show. Despite the recent market turmoil, the largest U.S. mortgage lender in the United States is planning to jump into the public equity markets with an IPO. Expected to file as soon as this month. Our own Leslie Picker broke the story, and she joins us now. And Leslie, it could be the largest IPO of the year. It's an interesting time for a mortgage company to be going public.
Absolutely. It could be the largest IPO of the year. Timing is interesting because, as you know, Dom, volatility is kind of the enemy for IPOs. But nonetheless, I'm told that the target valuation still being worked out here, but that it will be in the tens of billions of dollars. That implies a multi-billion-dollar IPO. Could surpass this year's largest, Warner Media Group, which just raised shy of $2 billion last week. Now, people familiar with the matter say that Quicken Loans has filed its IPO prospectus confidentially. They may flip it to be public as soon as next month. The company is working with Morgan Stanley, Goldman Sachs, Credit Suisse, and JP Morgan on the offering, those sources say. Quicken Loans is the largest mortgage lender in America. It's founded by billionaire Dan Gilbert 35 years ago. He's also known as the majority owner of the NBA's Cleveland Cavaliers. He's credited with revitalizing downtown Detroit, where the company is based. Quicken Loans CEO Jay Farner said on CNBC in mid-April that the company was estimating nearly $75 billion worth of mortgage applications in the second quarter. That's up from $53 billion in the first quarter. So mortgage rates hit a new record low yesterday, with the average rate on the 30-year fixed mortgage reaching 2.97%, according to Mortgage News Daily. Low rates have been encouraging homeowners to refinance, which could partially explain the timing here for why they'd be seeking the public market. Now, the company and all four banks declined to comment on the IPO. So hopefully we'll learn more in the next couple weeks in terms of, what exactly their financials look like, but certainly an interesting one to watch, Dom.
I mean, so first it was Lemonade, right? Mm-hmm. And now we've got this. These are not small IPOs that we're talking about. These are larger ones. And in the case of Lemonade, backed by a very large company like SoftBank. What exactly does that then say about the environment for IPOs? Does the market volatility not really factor at all into these IPOs anymore at all?
So I think that's the key question here, because before this week, we really saw a nice tick up in the equity markets, and all of these IPOs that had been, having the discussions with their advisors and doing the process, all of those plans were put on hold with the market volatility of March. And so when they saw the equity markets tick higher in April and May, they said, okay, maybe green light, go here. We'll continue this process. So is yesterday enough to really stop those plans? I don't think so. But, if that continues, we might see some pauses.
So Lindsay Bell, I want to bring you into this conversation as well. One of the things that you have a big lens on is the retail investor. Ally Invest has a platform for many people to be able to trade more freely and with lower costs, if no cost at all. What exactly is the sentiment among the retail investor side of things with regard to some of these hot IPOs that we've seen as of late?
Yeah, I think with the retail investor, what you see is IPOs are always very popular with them, and you've seen we have an uptick in new investors, retail investors over the course of the last several months, just like all the other brokerages, and they're much more active than they have been. Perhaps it's because they have more time at home, but I think what's interesting about the IPO market right now is that the companies that have gone public, so the 10 largest companies by market cap that have gone public since the beginning of April are up 83%. So that's a positive sign, which is why you probably see more IPOs coming to the market here at this point in time. Additionally, what I've noticed in the IPO market is that you've seen a lot of SPACs. So special purpose acquisition corporations from the likes of Goldman Sachs and Social Capital, among others, coming public this year. And I think that talks about the liquidity that is in the market, and these corporations or these financial firms are trying to take advantage of that right now. So they're taking advantage of the amount of cash that's sloshing around in these markets.
All right, it's a big deal for a lot of investors out there, the sentiment with this rising IPO market. Leslie Picker, Lindsay Bell, thank you very much. As we head to break, watching shares now of Tesla and General Motors in the pre-market as Goldman Sachs analysts downgrade Tesla to neutral from buy, citing challenges for the company's Model Y crossover vehicle, while upgrading General Motors to a buy rating on a positive outlook for U.S. auto sales. Tesla stock down more than 5% yesterday. General Motors down nearly 8% yesterday, but higher in the pre-market so far this morning. We are back right after this.
Today's big number, $55.9 trillion. That's how much the total U.S. debt surged to in the first quarter of the year, according to the Federal.
The station you're listening to is experiencing technical difficulties.
Today's big number is sponsored by Comcast Business, committed to keeping you and your business connected.
If you think about the last few months, maybe it'll give us a new perspective. Maybe we'll see things we've been missing. Maybe it'll help us see just how connected we all are. And maybe, just maybe, if we look at the big picture, it'll remind us just how amazing freedom really is.
No, I love these fries.
You know, the chef here trained in France.
It shows.
So good.
Oh, hey, did you say you needed help with investing? Because I know someone who's really great.
And you trust him?
Totally. Yeah, we went to school together.
I'll check him out on investor.gov. So what'll it be? I'll just have the burger.
Before you invest, get the full report. Check out an investment professional's background for free on investor.gov. Before you invest, investor.gov.
Everybody dance now. We turning up, we burning up, we always moving, further up. Que yo sé que te gusta. Hello mama, I can tell you wanna grab a couple friends, let's go.
Ballers and ballerettes, the perfect party begins now.
the show. One stock chart to bring your attention to as we look at futures right now. First of all, we are near session highs right now. The Dow Jones indicated higher by about 623 points. If these gains hold into the opening bell for regular cash equities trading, the S&P would go up by about 66 points and the Nasdaq up by about 188. Remember, though, the Dow Jones lost around 1,861 points yesterday. The S&P lost 188. So just to kind of put that in context for the time being. Now, one of the charts we're keeping a close eye on is this one here. Now, it's just month to date, not very long term. However, these names in particular, names like ExxonMobil, Norwegian Cruise Line, and Simon Property Group have been names to focus on because they have been some of the hardest hit during the economic downturn and have been some of the biggest risers as the economy has generally started to reopen. Look at this trade. Trajectory-wise, generally speaking, we've seen a nice move higher for the first few days of June as people really had some optimism about the economy reopening. But in the last several days here, we've seen that trend turn markedly lower. Oil prices tell the same story, but travel and leisure and retail certainly stocks to watch amid this kind of market turmoil. Well, let's check on this morning's other top headlines as well. NBC's Philip Mena is live in the New York newsroom with the latest. Good Friday morning, Philip.
Good Friday morning to you, Dom. Despite the coronavirus pandemic, 1,000 West Point cadets were called back to campus so that President Trump can deliver their commencement speech tomorrow. And now the deepening tensions between the president and top military brass have cast a shadow over the event. Just yesterday, Joint Chiefs Chairman General Mark Milley says that it was a mistake to appear beside the president for that now infamous St. John's Church, the walk there, after law enforcement attacked protesters to clear the way. And President Trump plans to return to the campaign trail next week on June 19th in Tulsa, Oklahoma. The campaign is requiring attendees to agree not to sue if they get COVID-19. The registration page for the rally includes a red button with a disclaimer that warns attendees assume all risks related to the virus and the campaign is not liable for any illness or injury. Meanwhile, there are growing concerns this morning that relaxing restrictions is causing major increases in COVID-19 cases. 15 states have seen cases rise by more than 25% in just the last week. Those are some of the top headlines on this Friday. Dom, back to you.
Philip Mena, thank you very much for that and have a nice weekend, sir.
You too.
When we come back on the show, breaking down one of the hardest hit sectors in yesterday's sell-off and asking if it's primed for a rebound. But first, this is the only stock in the S&P 500 stocks that ended the day higher yesterday as the index shed some 188 points. We will reveal this morning's mystery chart when Worldwide Exchange returns after.
Can I find an investment firm with a truly long-term view that's been through multiple market cycles for over 85 years? With Capital Group, I can. Talk to your financial professional or consultant for investment risks and information.
Okay, give it a try.
Between wisdom and curiosity, there's a bridge. Between ideas and inspiration, trauma and treatment.
Need a couple of more pounds.
That's good for the baby. Between the moments that make us who we are and keeping them safe, private, and secure, there's WebEx.
Beautiful. You can hide your age behind a statement necklace. Or let your neck make the statement.
Gold Bond Neck and Chest Cream improves texture, increases elasticity. 97% had firmer skin. Gold Bond, Ultimate Lotion, Ultimate Skin.
Yes, we have responsibility to our shareholders, but we also have a broader responsibility to society. And that includes giving everyone an opportunity to participate.
An easy way to address economic inequality is to make sure that equal pay is a reality. Right now, companies can take a look, and if they find inequity, fix it.
People of color have much harder time accessing mortgage loans. We've got to intentionally create programs and help solve this wealth gap.
For a close shave, you need to get a razor and lather up. For a quick shave on the go, you need to settle for an electric. But what if you really want both? Nick Bolton here with the newest addition to our tactical line, the Bell & Howell Tax Shaver. Tax Shaver gives you a quick, razor-smooth shave, whether you're at home or on the go. It even has a built-in trimmer for sideburns and beards. And it works wet or dry for a great shave in even the harshest conditions. That's right, the tax shaver is completely waterproof.
Act now to get your tax shaver for the special TV price of just $29.99 with free shipping. It's the only shaver that features genuine Bell & Howell precision and quality and is backed by our 10-year warranty. Here's how to order.
To order, call 1-800-953-7061 or go to taxshaver.com. That's 1-800-953-7061, or you can order online at taxshaver.com.
Poised for a rebound. Stocks looking to pick up the pieces after Wall Street's worst day since mid-March. Tech getting hit hard as Amazon, Facebook, Microsoft, Apple, and Alphabet shed a combined $270 billion in market value. Is there more pain to come? And Fundstrat's Tom Lee is here. His take on retail investors who got burned especially hard amid this recent sell-off and what it means for sentiment going forward. It is Friday, June 12th, 2020, and you are watching Worldwide Exchange on CNBC. Welcome back. I'm Dominic Chu in for Brian Sullivan this morning. With me for the entire hour has been and will be Ally Invest Chief Investment Strategist Lindsay Bell. She is also a CNBC contributor. We'll get to Lindsay in just a moment. But we begin this half hour with breaking news as U.S. stock futures look to open sharply higher after a rocky day for Wall Street just yesterday. The Dow falling more than 1,800 points to log its worst single session since March 16th when it fell nearly 13%. And as you can see here with the time lapse, it was generally lower all day and then picked up some downside momentum into the closing bell. Now, as bad as it was yesterday, yesterday's drop was for the Dow was only the fourth worst on a percentage basis, as you can see there, for the entire year. Remember, back on March 16th, we had some 13% declines for the Dow. For the week, though, the Dow is down more than 7%. The S&P 500 is down around 6%, as you can see here. And the NASDAQ lower by about 3%. Remember, for the NASDAQ, we hit record highs earlier in the week, and we're just about 6% below that mark right now as things currently stand. All of these indices are on track to snap 3-week winning streaks, and investors may want to buckle up for more swings, according to former Goldman Sachs Chief Operating Officer Gary Cohn, who spoke with the closing bell yesterday.
Markets always overshoot. We probably overshot on the downside, and we probably overshot on the upside. So if you look at where we are right now, we've come back down around 8% or so from the highs, but we're still up over 35% for the lows. We're in the period where we're trying to find a relative fair value for equities. That doesn't mean they can't go lower, and it doesn't mean they can't go higher. We're trying to digest right now what value should be.
All right, that price discovery taking place throughout the course of this particular last few days here. And we teased it before the break. Amid the sell-off, there was just one S&P 500 stock that actually ended the day higher. That name is, think groceries, Kroger, managing just a slight 0.4% gain here. You can see here up about 1.5% pre-market so far today. The grocery chain's been a rare beneficiary of the virus outbreak, with many restaurants closed and people working from home and cooking from home more. Kroger and other grocery stores have seen higher than normal sales of food and other consumer staples products since February. Well, let's now go worldwide, and a choppy session shaping up in Europe so far. Our Juliana Tattlebaum is standing by in the London newsroom with the latest there. Good morning, Juliana.
Good morning, Dom. Well, investors here in Europe are buying the dip. After the sharp sell-off that we saw yesterday, the stock 600 ending more than 4% lower, its worst daily performance since March 23rd. Now investors are swooping in and buying a lot of the stocks that suffered in the latest sell-off. So we've got gains across every major market here in Europe, led to the upside by France, the CAC 40 up more than 2%. Let's get you a check on sectors and what the breakdown looks like in terms of the buying. We've got the biggest demand for travel travel and leisure, banks, and auto stocks. So those companies that benefit most from a reopening of the economies around the world. On the downside, we've got healthcare, the only sector trading in the red this morning, down about 18 basis points, just about 0.2%. That's, of course, one of the most defensive parts of the market. So after the big sell-off, investors seem to be putting some of their money back to work. Dom, back to you.
All right, thank you very much. Juliana Tettelbaum live in London. Have a nice weekend. Among the worst hit sectors yesterday, the financials. U.S. and global banks fell more than the broader market overall, a day after the Federal Reserve highlighted the pandemic's potential to weaken the U.S. economy over the longer term. The S&P 500 financial index shedding over 8%, closing in so-called correction territory, down more than 10% from its highs, and then marking its worst day since mid-March. Let's get some more insight on the banks with Chris Whalen, chairman of Whalen Global Advisors. Also with us for the hour, Lindsay Bell of Ally Invest. She stays there. Chris, we are going to start with you, though. Let's talk about the banks. Have they been a recovery play, and was the rally that we've seen as of late, at least, warranted?
The rally, I think, was warranted. Back in March when we were talking about banks, they were trading well below book value, and then they retraced. U.S. Bank, for example, which I own, got back up to 1.3 times book, which is fairly valued. It's not as high as it was, but the stock is still up double digits over the last 30 days. So, you know, part of the downside of central bank intervention is that you get more volatility. And the money went into bonds for a while, and then it ran out of fixed income, and it went back into stocks. So as Gary Cohn was saying yesterday, we're trying to figure out what value is, but I think momentum is still the dominant factor in the market today.
All right, so if it's momentum, let's talk a little bit, Chris, about what exactly that momentum as of late is telling us about the banks. They've been underperformers for so long. They have not really been participating in the broad market rally since the COVID-19 lows. What exactly does that say about sentiment around the banks?
I think there's uncertainty. The big question is credit, and we still don't know exactly what we're going to see in second quarter earnings. We know that credit costs will probably be higher than the first quarter when they surged. So uncertainty, I think, still dominates the analysis. It's hard to talk about value if you don't know what credit costs are going to be over the next 12 to 18 months, and we don't. I think it was a big mistake by the regulators to give banks an additional 30 days to report first quarter, so we don't even have that. In fact, that data will be released right in front of second quarter earnings, and I'm not sure that's going to be helpful. So, you know, for a lot of analysts, we have questions, Dom. We don't have a lot of answers at this point.
All right, so Lindsay, there are a lot more questions than answers right now. Let's talk about one big question, and that is whether or not the financials are still key to any kind of a market rally, as they have traditionally been in years and decades past.
Yeah, I mean, you definitely like to see the financials and the banks lead the way out of any type of recession. It's a sign that there's a light at the end of the tunnel, and we see future growth coming our way. So that is definitely something you want to see. The financials did have a nice pop going into this week, which was nice to see. But like Chris says, there are still a couple of question marks with regards to the bank interest rates. The Fed didn't do the banks any favors this week by stating that they're going to hold interest rates at 0 for 2 years. But I think that what's interesting about this group is that because they had been beaten up so much, and you're now seeing another pullback, this potentially could be another good entry point if you haven't gotten exposure to financials yet, and you do think that we're going to get through this crisis in the latter part of this year and into next year, because the consumer really has been has shown signs, at least more recently, that they're going to be able to come out of this a little bit stronger on the other side, which of course will benefit the banks on the longer term. But near term, we are worried about where credit is going. Loan loss provisions are expected to increase in the second quarter. I don't think that would be a surprise to the market, but a stronger than expected economic recovery, of course, would benefit the banks.
All right, so Chris, you know, Gary Cohn, the former Goldman Sachs chief operating officer, talked about price discovery. You talked about valuations. So let's blend those two together. What goes on the shopping list if you're looking at some of the better valuations, relatively speaking, and some of the prices that we've seen come down as of late? All right, I think we're having some technical difficulties with Chris Whalen there. Anyway, Chris Whalen, thank you very much for joining us this morning. Also, Lindsay Bell, thank you. You're sticking around for the rest of the hour. Coming up on the show, why it could be the end of a trend for casino stocks after a surge higher in recent days. But first, a quick check on a few other names that we are watching in the pre-market, including Dave & Buster's, surging despite missing on the top and bottom lines for its most recent financial quarter. Same-store sales also falling nearly 60% compared to the same time a year ago. The company was forced to close all of its stores on March 20th as the COVID-19 pandemic took hold. We are back right after this.
I'm Ken Coloma. It's my job to make sure all the packages that go out today get delivered. There are people who can only get food from Amazon. When you come into work, that's what drives you. My little one, I would say he's definitely proud of me. Every time he sees the blue Prime trucks, he says, "Daddy, there's your people." I know every single one of us is here busting as hard as we can go every day to make sure these packages get delivered.
Can I find an investment firm with a truly long-term view that's been through multiple market cycles for over 85 years? With Capital Group, I can. Talk to your financial professional or consultant for investment risks and information.
How many golf courses can you play with Golf Now? Well, let's just say you have so many choices, you'll feel like a connoisseur of course selection. With Golf Now, you don't just have a lot of courses. You have over 9,000 picture-perfect places to play. Book around anytime at a course near you at the #1 place to book tee times. So, what are you waiting for? Go to golfnow.com and book your round today. Golf Now. Go play.
Tommy John is comfort reimagined for men and for women.
We use soft, breathable, lightweight fabric with stay-put waistbands that never dig and stretch where you need it. We made a women's line so comfortable there are no visible panty lines and no wedgies, guaranteed.
Go to TommyJohn.com right now to see all that Tommy John has to offer. From the most comfortable and breathable underwear on the planet to the most luxurious loungewear and clothing you've ever felt. For a limited time, get 25% off site-wide. Plus, we'll ship it to your door for free. Business hasn't experienced anything like this. We have to transform our workforce fast.
We need guidance. Who can help?
That's what Kelly does. We can help your business meet this challenge by providing you with the right talent solutions. Visit that'swhatkellydoes.com.
Welcome back to the show. Amid fears of a possible second U.S. lockdown and increasing COVID-19 cases in states pushing to reopen, one sector is getting hit especially hard. Our own Kate Rogers joins us now with that story. And Kate, it's all about dining out.
Hi, Dom. That's right. Good morning. Restaurants really taking a hit yesterday, as you mentioned, on fears of a second wave of COVID hitting the economy. Some names faring a little bit better than others here. Casual names clearly took the biggest hit yesterday. Names like Darden, Olive Garden parent company, Brinker, Chili's parent company, and Bloomin' Brands, which is Outback's parent company, all taking a bigger hit than most, as these names are most closely associated with on-premise dining. Starbucks also closed down around 8% yesterday. Earlier this week, it said it projects a $3 billion loss in Q3 due to COVID, lowering its EPS guidance and also announcing it would halve its projected store openings for 2020, shifting to on-the-go format locations in big cities around the country. Some names, though, holding up a bit better are those that have seen business hold steady and even grow during the pandemic. Chipotle, Domino's, Papa John's, and Wingstop all down between 2.5% and 3.5% on Thursday. These companies all have robust carry-out and delivery platforms and partner partnerships as well to cater to consumer preferences in this new normal. The sell-off on spiking COVID cases, we should note, comes at a time when new data from the NPD group shows that as of May 31st, nearly 70% of restaurants are in cities and states that are now open for some form of on-premise dining. As a result, major chain transaction data continues to improve, overall down 18% year on year. That's actually a 3% increase from the week prior. Full service chain transactions fell by 37%, quick service by 16%, Dom. So we'll have to see what these spiking cases mean for that transaction data moving forward. Back over to you.
All right, Kate Rogers, thank you very much for those trends there and what's happening with restaurants. And Lindsay, I guess I want to bring you into this discussion really quickly as well. You mentioned the consumer picture before. What exactly are you looking for with regard to what consumers are spending on to show you that the economy is actually picking up some steam?
Yeah, it'll be interesting to analyze some of the credit card data as we move forward and the consumer spending begins to pick up. We know the savings rate is at 10% from the last report, which is extraordinarily high. So we do believe that there is some pent-up demand by the consumer. And of course, the jobs data, like I mentioned earlier, was encouraging for the May report. We'll see what June brings and July as well. We'll see how unemployment continues to trend because there are still a lot of people out of work. And then in July, we do have an expiration of that unemployment bonus of $600 per week. But the government is expected to intervene with some sort of stimulus to help continue to support the consumer. So we just think that there is going to be demand to spend. What I do think is interesting is you are seeing these trends pick up, and Kate made a really great point. It's going to be important to see how these trends change over the course of the next couple weeks with cases spiking. But ultimately, I think companies that had cash going into this crisis that serve customers in a quick service fashion, that make it easy to get their food and go quickly, they can continue to do well. And those that have access to the SBA and PPP loans are the ones that are going to be able to survive this crisis the best.
All right, the consumer does make up more than 2/3 of the U.S. economy, so they are key, of course. All right, Lindsay, we'll be back with you in just a moment here. Nearly 60%, by the way, of casinos nationwide have reopened their doors to the public for business, according to the American Gaming Association, and early indications suggest demand for gaming still exceeds the available supply, leading large operators like MGM and Caesars to reopen even more locations. But a rash of COVID outbreaks in the United States and fears of even more contagion, the hot trade into gaming stocks may actually be over. Let's bring in David Katz, Managing Director at Jefferies, covering the global gaming, lodging, and leisure and equity research industries. Lindsay Bell remains with us. David, let's talk about those casinos. There was a lot of momentum upside-wise over the near to medium term for them because of the optimism around reopening. Is it justified, and is the pullback justified?
Look, I think what we're seeing this week is a give back of some of the gains that we've seen over the prior couple of weeks. And, I think we're taking a very measured view as to what's going to happen in the near term. I really do think the street is trying to gauge what 2021 is going to look like. But as you pointed out, Dominic, somewhere between half and 2/3 of the available gaming supply and hotel rooms are open. But we point out that in markets like the Las Vegas Strip, there's no entertainment. The restaurants are spaced out considerably. And what we're seeing are visitation who we expect are likely driving. And as you may know, about half of the visitors in Las Vegas drive and the other half fly. Presumably what we're getting are the drivers. Now, what we also need for certain markets to do well are the events, conventions, and the big groups. And we are nowhere near having those re-enter any of the markets that we cover, including Las Vegas.
All right. So David, I guess as I look at in the years I've covered casinos and the gaming industry, there is a difference between, say, a Las Vegas Sands and an MGM versus, say, like a Penn National Gaming. What exactly then can we look at in terms of who the outperformers will be, given what we know and what we don't know about the COVID-19 situation right now?
It's a good question, Dominic. A very good question, Dominic. It's the key question. And in fact, when we look at regional markets, what we know is that more than 80% of the revenue they generate comes from the gaming floor. And of that, more than 80% is driven by slot machine revenue. That's much different from what we see in Las Vegas, where less than half of the revenue is coming from the gaming floor. And so much of it is coming from restaurants, entertainment, the big groups and conventions that come into town. The implication of that is that the regional markets that you point to, which we have been positive on since the outbreak began, since the pandemic began, are people who typically drive within an hour. They make very regular visits, and their spending patterns tend to be very regular. And what we also know from those operators is that they get more than 75% of their revenue from 25% of the customers. And while only part of the floors are open, they're making sure that 25% of the customers get in the door and are comfortable. And so I think that's partly why they are indicating that the revenues they're seeing so far in June have been very good, Dominic.
All right, it's a huge kind of transaction-driven trade to watch there for sure. David Katz at Jefferies, thank you very much for that outlook on the gaming industry. We appreciate it. Well, still on deck for the show, retail investors getting burned amid the recent market turmoil. FundStrat's Tom Lee on what it means for you and your money and the markets. That's coming up next.
Land Rover, above and beyond.
Brett Favre, legendary quarterback. Jerry Rice, legendary wide receiver. When legends play, they wear Copperfit Advanced Back Pro. Copperfit's best-selling compression back support just got better with new double-band adjustable supports for customizable compression when you need it most.
That's what I'm talking about.
4 built-in stabilizing supports designed to improve posture and help reduce lower back stress and strain.
You have back pain, and it's affecting your everyday life. Do something. Since I put this on, I feel so much better. The core is the most important thing. To know that I'm stabilized here. Whatever I'm doing, I can give it 100%.
Or call 1-800-461-1973. Or on the web at advancedbackpro.com for only $19.99.
This does feel good. That's what I've been saying. You think it was fair? It was fun. Copperfit. Live limitless.
Can I find an investment firm with a truly long-term view that's been through multiple market cycles for over 85 years? With Capital Group, I can. Talk to your financial professional or consultant for investment risks and information.
I found a way to relieve my constipation that's both gentle and fast.
New great-tasting Dalcolac soft juice works naturally. Dalcolac soft juice. The station you're listening to is experiencing technical difficulties.
Welcome back to the show. Futures right now pointing to a bounce back this morning as Wall Street tries to recover from the worst day since mid-March yesterday. Individual investors were hit hard. But as you can see here, the Dow is indicated higher by about 600 points if these gains hold into the opening bell for regular cash equities trading. Data shows the most bought stocks on free trading application Robinhood during the prior 24 hours were all in the red yesterday. We've got the names. It's Ford, General Electric, American Airlines, Disney, and Delta. Joining us now, FundStrat's Tom Lee, also Lindsay Bell of Ally Invest is still with us here as well. Tom, let's talk about how much the retail trader has become the main headline story over the last couple of weeks. Why is it that we're paying so much attention to what they're doing?
I mean, the retail trader's always been important because, you know, when I did internet in the 90s, they were the ones that really discovered internet stocks. And as you look back, even stocks like Netflix. And I think the reason they've been really important since March is that institutional investors have really been cautious. That's why we have record institutional money market cash. And older retail investors, because you can see it through retail money market cash and through some of the surveys really targeted for baby boomers, have been quite uncertain too, and they're sitting on record cash. So the only really active investors in this market are, algos, and then younger millennial traders. Of course, there's others, but they've done exceptionally well. So I think the retail trader has been a positive impact actually in this market, and the fact that they're buying epicenter stocks, I actually think that's correct. I think directionally that's what people should be doing. I think that the economy went through a heart attack, but now the real opportunity is in the stuff that really was at the epicenter of the crisis.
So does that mean, Tom, that the retail investor has gotten more sophisticated over the years? It used to be that they were kind of like the punchline, right? When they started getting in, that's when you wanted to get out as smart money. Does that mean retail has become smarter about what they're doing with their trades?
Absolutely. I mean, number one, look at some of the big retail names in the past couple of years. Tesla, I mean, it's been a monster, absolute monster. I mean, the institutions have been shorting that stock. And if it's not in the Russell 1000 or if it's not in the S&P 500, people ignore it. I think information is definitely at the fingertips of people now because of social media. And look, we can all now access financials online. People can build APIs. All the dashboards on these retail systems are very similar to the sophisticated systems people used to use institutionally just 10 years ago. So, of course, financial education isn't the same. I mean, not everything we're seeing is directionally correct. For instance, I used to do bankruptcy research. When I was at JP Morgan, I did that, I wrote a series called Chapter After Chapter 11. And, 99% of stocks going bankrupt cancel the equity, once you've completed your reorganization, but not always. AMR was an exception. So I think, there are some places where it is a little worrisome.
All right, so speaking of social media and information, Lindsay, one of the tweets that you put out over the last week really caught my attention. You said at Ally Invest, the data that you're looking at showed some of the retail traders that you guys cater to actually selling ahead of this particular sell-off. What exactly are you telling us about what they're showing in terms of their sentiment?
Yeah, so last week we saw one of our highest volume weeks in trades among our retail customers since March. And we saw a lot more selling than what we had seen in the past. In the month of March, it was a lot more buying than it was selling. And some of the stocks that they're selling the most had been AMC and also Alibaba were the two most notable. But I would also echo what Tom has just said. We've seen the baby boom generation really, they've been left out of this last rebound in the stock market. It's really been driven by millennials and to a lesser extent Gen X, at least from what we've seen on our Ally Invest platform. Another thing I would note, if you look at some of our top 10 traded stocks from March 23rd to this Monday, those stocks include names like American, Boeing, Carnival, Delta, Tesla, United, AMD. So your stereotypical names you would think among the retail investors. Those stocks had advanced 137% on average going into this week. Going into yesterday, those stocks together combined are down an average of 30%. So these stocks are still up if they got in early. And while they may be volatile stocks going forward, sure. They could be the right call longer term.
All right, Tom Lee, Lindsay Bell, thank you very much for those thoughts and the importance of the retail investor. We appreciate it. That does it for us here on Worldwide Exchange. Squawk Box picks up the coverage next.
Need better sleep? Try Nature's Bounty Sleep 3, a unique tri-layer supplement that calms you, helps you fall asleep faster, and stay asleep longer. Great sleep comes naturally with Sleep 3, only from Nature's Bounty.
Can I find an investment firm with a truly long-term view that's been through multiple market cycles for over 85 years? With Capital Group, I can. Talk to your financial professional or consultant for investment risks and information.
Meet Gravity, the original weighted blanket for sleep, stress, and anxiety. Gravity is the only weighted blanket demonstrated to improve sleep and reduce stress. Now available in cooling for summer.
We are KiwiCo, and we deliver hands-on STEM projects designed to inspire young innovators. Kids of all ages can explore science, engineering, art, and more. Get 30% off. Visit trykiwico.com. Must be 18 or older to log on.
This is a keepsake frame. This is actually a photo from my wedding. Keepsake is incredibly simple. You just choose a photo that you love. You can preview it in over 100 frames, and in a couple of days, you're going to receive your photo in a beautiful handmade frame.
Looking to refinance your mortgage? The first thing you want to do, find out how much your home is worth.
Just go to ownerly.com, enter the address, and see the home value instantly. Come to ownerly.com and see what your home is worth for free.
Pete Davidson is the king of Staten Island.
Are you a weirdo?
Oh, the weirdest.
You make everyone around you crazy. People are normal, then they hang out with you, and then they have Jack Nicholson in The Shining.
I gotta tell my mom you tried to drown me.
To the above ground pool, you're like 8 feet tall.
The King of Staten Island. Rated R. On demand now. Go to thekingofstatenisland.com.
Hi, how are you? On Squawk Box, Elon Musk and Tesla on a tear. The space launch, soaring stock price, raising the stakes for electric vehicles. Inside a company climbing for more. Today, watch or listen live on the CNBC app.
Good morning. Stocks looking to bounce back after an 1,800-point sell-off in the Dow. We will show you the biggest moves straight ahead. Investors on edge over an uptick in coronavirus cases and hospitalizations in a dozen states. The White House says the economy will not, however, go on lockdown again. Despite the turmoil, we may soon see the year's biggest IPO, and it's a familiar name for millions of homeowners. Friday, June 12th, 2020. Days are going to get longer for another week and a half or so. Squawk Box begins right now.
Good morning, everybody. Welcome to Squawk Box here on CNBC. I'm Becky Quick, along with Joe Kernan and Andrew Ross Sorkin, and we're going to start this morning with the markets. This comes a day after the Dow plunged more than 1,800 points, or 6.9%, and believe it or not, it's only the biggest drop we've seen since March. It tells you just a bit about how volatile these markets have been in recent months. If you've been watching what happened, we had been talking at the beginning of the week about how the Dow, over 6 winning sessions that ended on Monday, over that period of time, it really racked up some phenomenal gains. It was a gain of 2,189 points. Well, since then, we've given all of that back and then some. On Tuesday, we lost 300 points for the Dow. On Wednesday, we were down by 282. And then yesterday, the market was down by 1,861 points. You add that up, it's a decline of 2,443 points. So all of that ground we had gained over those previous sessions being given back. This morning, however, as you might anticipate, there is a bit of a bounce back. Dow futures are indicated up by about 626 points, and normally that's the type of move that would make you sit up and say, wow. But again, it's only about a third of the points that were lost yesterday in those markets. S&P indicated up this morning by about 69 points, and then the NASDAQ is indicated up by 192. And as you might anticipate, Treasury yields have been moving all over the place as well. Let's take a look at what's been happening right now. We did see the 10-year, I think it was on Monday, it was up at 0.9%, a little bit higher than that. This morning it's at 0.72% after trading below that on yesterday with what we saw in the trading. And this was really something to watch. We had seen those heavy losses early in the morning when we were looking at it, but that just accelerated throughout the course of the day. And I think everybody was kind of on tenterhooks as we were watching to see what happened at 4 p.m. yesterday.
You bet. Becky, we've got a huge lineup of important guests. It's like rains and pours. It happens. We've been blessed by having some really great guests over the past several weeks and months now. Here's some highlights of what's on tap this morning. We've got David Rubenstein, of course, the co-founder of Carlyle. Sandy Weil is going to be joining us, former Citigroup CEO. We've got the former White House Chief of Staff Mick Mulvaney joining us, and we have the founder and chairman of Interactive Brokers joining us as well. So a lot going on there. Plus, let's talk about today's top story. Breaking news overnight right now, the UK's GDP falling by 20.4%. That's in April compares to the previous month. That's the largest monthly fall on record, as the pandemic lockdowns have, of course, battered the economy. London's FTSE down now more than 18%. That's just year to date. Joe?
Alexandra, has Leisman heard yet? That's the first person I thought of. The annual Kansas City Fed Symposium in Jackson Hole, Wyoming, officially canceled. Steve gets some fly fishing in out there, gets to meet with all the big muckety mucks. Instead, the Fed's going to hold a virtual meeting focused on a small issue, navigating the decade ahead. They're not, biting off more than they could chew. Navigating a decade where interest rates are going to be zero the entire time, reported. No, maybe not. Maybe not. He didn't quite say that. But we are going to be zero for a while. But that's a big job, it seems like, to go out 10 years on anything.
Joe, not necessarily. We're going to be zero for a while unless we go negative.
Yeah, exactly. Let's not go negative. When people go negative, when people go low, let's go high. That's just what I think we should do, just in general.
Let's be positive.
Right? Okay, for a morning show. It's going to be the first year since 1982, and I think Leisman's been every one, that the event won't be held live at the Jackson Lake Lodge in Grand Teton National Park. And I was thinking, it's the Kansas City Fed. I mean, Kansas City's a great place. Great jazz, great steaks.
I'd pick Jackson Hole, too.
Right, I would. But if it's close, I mean, if you're in the neighborhood, let's do Jackson Hole. It makes sense for me that
especially in the summer.
That's what they do. But we do talk about it every year, right? And it used to be, it used to be Greenspan, it used to be Bernanke, it used to be Yellen.
The crazy thing is, every year it seems like there's big market news that happens just in time for that confab, too. So it kind of plays right into their hands. It's awesome to be able to go to Steve and to be hearing everything that they're talking about, because it seems like every year, at least in recent years, there's been some market turmoil that takes place right around that.
Yeah. Virtual doesn't quite do it compared to Jackson Hole, especially, being there. It's such a great spot, is it not? It's dry, sunny. It's nice. It's a good place.
Fishing for Steve.
Room to move. It's an old song. All right. That's all. That's all.
All right. Despite everything we've seen happening in the markets lately, the largest mortgage lender in the U.S. is planning to jump into the public equity markets with an IPO. Quicken Loans is expected to file as soon as this month. Leslie Picker reports that the target valuation is still being worked out, but that it would be in the tens of billions of dollars, implying a multi-billion-dollar IPO. That could surpass this year's largest, which was Warner Media Group, which raised just shy of $2 billion last week. And it's kind of phenomenal that this company has not gone public already with what they've managed to do and just how big they've become in the industry. They have kind of moved far ahead of everything that we've seen out there. So you might anticipate that this would be an IPO that picks up quite a bit of interest despite what's been happening in the market.
Yeah. Is it a stock IPO, or is it really it's sort of a based on real estate and mortgages and interest rates and things like that? I mean, it's a stock. I understand
that. Sure, it's based on their book. It's based on their book. They have a massive mortgage book.
Right. But it's still, it seems like it's on something that, it's not on a cruise ship. I mean, a cruise line or something that's much more.
No, I mean, this is a real business. Yeah. And with rates being so low, you have seen more demand, not only for people getting mortgages, but getting refinancing that comes through. And Quicken Loans has done this kind of amazing thing. The way they've built it so big is that they've done it all on technology. They've got like that Rocket mortgage loan book that you can get in, where it instantaneously, like they'll give you a delay and tell you they'll come back in 15 minutes, but they really could do it instantaneously. They just realized that people wanted to, they didn't believe the numbers when it came back instantaneously, so they actually slowed down how quickly they do some of these things. But they've been able to do it and build up this huge branch because they rely so heavily on technology, and that's given them an advantage.
How many times did you look at the stock market yesterday between like 2:30 and 4? We're just wondering.
How many seconds are there in a day?
Yeah,
I think I was glued on it the entire time.
When you've seen, I'm not going to talk about the past, but when you've seen things like here I go. But when you've seen things, like 1987 or something like that, you just never know. Or even what we had earlier this year. I mean, because anything's possible when it gets like it starts snowballing. And when I knew it was not going to stop at 800, 900, 1,000, 1,100. And it was just going, I thought we were headed for 2 for a while.
Yeah.
But I'll tell you what I was watching, honestly. I was watching the Dow, because it's at a high level, those points just add up to where you just have this sickening feeling. So I was watching the S&P, and one thing that I was taking some solace from was that it was holding above 3,000. I was thinking 3,000, we all would have signed on for 3,000 like 2 months ago. We all would have, for a year-end 3,000, and anybody said 3,000, it was like, wow, you're awfully optimistic. And it did hold there. We're going to have Katie Stockton on. We can talk about whether it does hold. And 7% when we were up 7% last week, you're really sort of just giving back maybe some of the, but I mean, I'm not saying we're out of the woods by any means. I did feel a little better after reading the Wall Street Journal's op-ed pages today, where they go and go deep into the numbers in Arizona and Texas and Florida with their lead editorial. And, I don't know whether they're not necessarily sugarcoating things, but they did point out some factual things that we need to consider. And even Scott Gottlieb said it's not a second wave. It's sort of states that didn't go through the first wave. So I don't know. And I was thinking about Europe. Europe has been somewhat successful in reopening, right? They're about 2 weeks ahead of us, or a month ahead of us or so. And they have not had the worst case scenario, right? I mean, is there still hope? I hope there's still hope. I'm hopeful that there's hope.
There's always hope. There's always hope. Joe, you know what you said about kind of watching these things as they heat up and knowing that it's not going to end well and that it's going to continue.
Yeah.
We're going to show you some sound that popped up on Twitter yesterday of Warren Buffett back in 1962, the day after the flash crash, when the market saw its biggest point drop, at least, since the Great Depression. That was back in 1962. He was 31 at that point. And you can listen to what he had to say the day after that and kind of put things in perspective. It reminded me of something that he probably said today,
Is it
too.
Video, too, or just it's video?
Yeah, it's
Do we
video.
get to see him?
I'd never seen video of him before. I'd seen old pictures of him, but I'd never seen old video.
That should be good. So, we'll look forward to that. And he was probably similar to what he says now when there's a tumultuous times. Yeah.
I'll show you in 10, 15 minutes. We'll give you a peek of it.
Okay.
But it just reminds you that we go through these things. We've seen these things before. And that was actually in the middle of the Kennedy slide, think Bay of Pigs invasion. And from January through June of 1962, you actually saw the S&P drop 22.5%. So on this one day, the Dow was down by 5.8%. And it had people kind of reeling and wondering what would come next. And those were difficult times, too. So we'll talk about that in just a minute.
Where'd you find that? Someone...
It was on Twitter.
Oh, it was on Twitter.
Where's everything?
Twitter's not all bad.
Where's everything?
Pretty bad, but not all bad.
Interesting. Anyway, when we come back, one of the biggest concerns for the markets, the resurgence in coronavirus cases in just about a dozen states. Dr. Scott Gottlieb will weigh in next. And after the sell-off yesterday, we continue to watch technology. Microsoft, Facebook, Apple, Amazon, and Alphabet all closing sharply lower, shedding more than $269 billion in combined market value just yesterday alone. Those stocks this morning, take a look at that in just a moment. Squawk Box will be right back.
Can I find an investment firm with a truly long-term view that's been through multiple market cycles for over 85 years? With Capital Group, I can. Talk to your financial professional or consultant for investment risks and information.
Our retirement plan with Voya gives us confidence.
We can spend a bit now, knowing we're prepared for the future.
Surprise!
We renovated the guest room so you can live with us.
I'm good at my condo.
Well planned, well invested, well protected.
Voya, be confident to and through retirement.
Derek, seems like your team's operating just fine remotely.
Yeah, everything is running smoothly with the Now platform. See? Incident resolved.
How did you?
Gotta enjoy the small wins.
You keep being you, Derek. Keep being you.
ServiceNow, the smarter way to workflow.
On Squawk Alley, breaking the cycle, what companies are doing now to diversify and bridge the divide.
Then is anything going to change?
Corporate Insight Smart Solutions. Squawk Alley, 11 a.m. Eastern. Watch or listen live on the CNBC app. CNBC's Disruptor 50 list revealed. Innovation accelerated by a global pandemic.
These are the names and ideas shaping the new normal.
Special coverage on air and online begins Tuesday on Squawk Box.
I'm a performing artist, so a healthy diet is one of the most important things. I also feel the same way about my dog. We were feeding her dry, triangle-shaped ingredients long as the yellow brick road. We didn't know how bad it was for her until we actually got the good food. We got her farmer's dog sent in the mail. It's all fresh. When she started eating healthier, she started being more active and smiling more, running more, playing more. I want my dog to have a healthy and long life. The farmer's dog really helps that out.
See the benefits of fresh food at betterforthem.com.
The Ridge wallet does a lot more than a typical wallet. It's small and modern, expands to hold cards and cash. It's made of military-grade materials, comes in 12 colors with a cash strap or a money clip. It blocks RFID, has a lifetime warranty and free shipping and returns. Order it today at ridge.com.
Want to eat better while staying in? Meet Freshly. We're here to help with chef-cooked meals ready in minutes. Skip the shopping, cooking, and cleaning. And get meals delivered fresh, not frozen, right to your door. Build your weekly menu today at freshly.com.
An update now on the resurgence, or is there a word? Is resurgence a word? Anyway, it may be resurgence or the first wave, really, in some states. We're talking Arizona. The health department there is reminding hospitals to be in emergency mode over the weekend as intensive care units approached 80% capacity. The number of cases in the state has risen nearly 300% since May 1st. It has doubled since Memorial Day. Now, testing has increased in the last few weeks. 53%, but the actual increase is quite a bit more than that. Positive tests have also been ticking higher as tests have gone up. Meantime, Texas set 3 straight days of hospitalization records this week and surpassed 2,000 a day for the first time. The CEO of one Houston hospital network said that the case numbers, hospitalizations, and proportion of test results that are positive are all flashing warning signals. Becky.
Joe, thanks. Nashville Mayor John Cooper announced a delay in Phase 3 of that town's reopening plan following a rise in COVID-19 cases. The mayor said the majority of our public health metrics are satisfactory, but our 14-day new case average remains slightly elevated, prompting us to stay in Phase 2 of our roadmap for reopening Nashville. Joining us right now to talk about all of this is Dr. Scott Gottlieb. He's the former FDA commissioner. He's also a CNBC contributor, and he serves on the boards of both Illumina and Pfizer. And Doctor, thanks for being with us. It's good to see you this morning.
Thanks.
I don't know that there's anything that really explains the market's huge surge up and then the huge decline that we saw yesterday. But people will pin it on things saying that it looks like in some of those cases with some of those states, if there is a resurgence, they start worrying about either a second wave or a first wave hitting areas that it hadn't seen before. How concerned are you about any of those ideas?
Well, I don't think this is a so-called second wave. I think we have to look what happens in the fall when we might experience a true second wave. These are outbreaks in states that, by and large, have not been hard hit by coronavirus, where they're seeing an uptick in cases. And to some extent, some states have isolated the cases to certain communities and certain settings. In other cases, they haven't. So you see Arizona, where they're averaging about 1,200 cases a day. Texas, almost 2,000 cases a day. The concerning thing is that the positivity rate's going up in these states. So they're testing more, they're capturing more cases, but the percentage of cases that are positive is rising. So in Arizona, it's about 15% now. Texas, around 7%, the positivity rate. South Carolina is around 11%. And so the fact that that's going up is concerning in these states. But the national trend is still relatively flat. We're experiencing about 20,000 cases a day on average. The positivity rate's around 5%. And so a lot of parts of the country are doing well, aren't experiencing increases. These are states that were relatively not hard hit. I don't want to say unhit. They weren't as hard hit as other states on the initial go-around. Perhaps they let their guard down a little bit, not just on a policy level, but the people as well. And now they're seeing some resurgent infection. But they have an opportunity to get this under control. They have the testing in place to do that this time. And so they need to focus on trying to trace back these cases to their sources.
Hey, Doctor, I don't know if you were hearing our conversation earlier, but Joe had mentioned this op-ed in the Journal this morning, and one of the things that, for example, the governor of Texas has mentioned is that he's saying it's actually much more contained than the numbers, for example, in that state would suggest, referring to the fact that he said 45%, I believe, of the cases that we've seen since early May there are the function of things that have happened in nursing homes, things that have happened in prisons, and in isolated meatpacking situations. Does that make sense to you? And does that mean it's isolated?
Not really. Those institutions have been very hard hit nationally, but they've become the sources of larger outbreaks all across the country. And so what often happens is the virus gets into an institutional setting, spreads very quickly through that setting, and then spreads outward into the community, and they become the sources of spread. It'd be reassuring if they were able to identify cases early in those institutions and isolate them before they got into the community. But they now have community spread in places like Houston and Austin. I mean, it's isolated insofar as it's a handful of cities where the outbreaks are occurring, and so they can target interventions in those cities. They have a chance to get this under control. I don't think this is like the cusp of New York's epidemic. When New York had, a couple hundred cases, we knew it was thousands and thousands of cases, but we had no testing. We couldn't isolate it. Now they have enough testing that they know this sort of true scope of the outbreak in Texas, and they have an opportunity to intervene. You saw what happened in Oregon overnight, where the governor stepped in to put a pause on the reopening of that state after hitting a record number of cases. It's 170 cases that they hit yesterday, but in Oregon, it's a lot of cases. It's a small state. And that's another state that really got through the first wave, if you will, without a major epidemic. And so this is an all-time high in cases. Texas may need to do something similar, where they pull back a little bit in the parts of that state where they have these outbreaks underway. You have to ask, should bars be at 75% capacity right now in Houston with an outbreak underway? And so they might want to look at some of those things and pause certain reopenings in the places where it's spreading until they can isolate it.
Hey, Scott, let's go back to this idea of what happens from this. I'm guessing that this is not all that unexpected for you. And I guess one question I have, if these states are showing much worse levels in terms of positivity rating and showing that there are potential outbreaks, were we wrong to have a national policy where we actually shut down the entire country at the same time?
No, I don't believe we're going to shut down again. And this is going to be the new normal, where we're going to have these rolling outbreaks throughout the country, and we're going to have to take targeted action.
I'm not talking about shutting down the entire country again. Should we have shut down the hot spots before, let other areas kind of go about their business until the outbreak hit them too, and then shut them down, more like a rolling shutdown instead of shutting everybody down at once? Or did we do the right thing by shutting down nationally and preventing the spread?
Yeah, I mean, that's the question people are going to be asking for a long time. Could we have targeted the shutdown better to the hotspots? The problem was we didn't really know where the hotspots were when we were going through this during the first wave. We had no testing, and so we didn't know where this was going to evolve to. We had major epidemics underway in some very large cities. I think people overestimate how much the national shutdown was really driven by policymakers. The shutting down of social and economic interactions was driven by people's fear and worry. If we hadn't shut down by the time we reached 3,000 deaths a day, we would have. And that's what happened in the UK. They didn't initially shut down, and then they were driven to shut down. The White House and governors did not shut down the NBA. The NBA shut down the NBA because they were reacting to what was happening and what was happening to fans and people. And so that's what's happening now in reverse, really. People are driving the reopening because they're tired of the shutdown, and so they're forcing policymakers to reopen the economy. Most states didn't really achieve the criteria set out by public health officials for reopening, or the White House, yet they reopened because the people demanded it. And so I think a lot of this has been driven by consumers, by school districts, by businesses that took these actions on their own, and ultimately policymakers fit policy to what was happening across the country.
Right. But Doctor, let me just ask you about that, which is, can I just follow up on this, which is, could have you seen, sorry, I apologize. Could have you seen a scenario where, for example, you shut down flights, but you didn't shut down huge parts of the country, meaning You look at a hotspot like New York, part of the issue was people were continuing to fly in and out of New York the entire time. And for some reason, we decided to keep the airlines up and running for the entirety of it. If flights had been shuttered, wouldn't it have changed the entire dynamic? I've heard a number of health officials make that suggestion.
Look, there were discussions about shutting the flights. I thought it would have been a bad idea because the volume collapsed on the flights immediately. The volume collapsed, and it continued to collapse. I think you needed to maintain some element of travel because it's a source of liberty in this country. To shut down travel completely would have denied people who truly need to travel for family emergencies, for compelling personal reasons. It would have denied them the opportunity. By and large, people stopped moving around in this country. I'm not sure that intervening to try to block transportation would have cut down on interstate travel anymore. I mean, it was inevitable that some of these interventions, when policymakers put them in place, were going to rub some people the wrong way, and we were going to overreach in certain elements of what we did. But by and large, what we were doing was mirroring what was going on in private industry, in local districts. I mean, the local communities are the ones who made the decisions to close the schools by and large. I will say, I think this is going to, though, be debated for a while. Could we have targeted this to the regions that were truly hot? And my answer to that would just be, we didn't know what regions were hot. We really didn't. We were flying blind in February, March. We take for granted how much capacity we have right now to do testing and interventions. We did not have that in February and March when we were going through this.
Will we be better prepared if there is a resurgence in the fall, a serious resurgence? You think we'll be better prepared to identify that and then have the ability to do localized shutdowns? Or do you think, based on what the White House was saying yesterday, that we can't shut down again, that we won't see any shutdowns anywhere?
Well, I think the White House and others need to change the lexicon a little bit. We're going to be much better prepared to identify outbreaks, as we are now. We're identifying outbreaks that probably in February would have evaded our attention. These are community outbreaks. Hospitalizations aren't up substantially. And so we need to be prepared to take targeted interventions. And so an example would be in Houston. Should bars be open at full capacity or near full capacity in Houston right now, or do you close them for a week? Maybe, maybe not. You have to determine whether or not that's the source of the spread first. We have the capacity to do that. We shouldn't view targeted interventions as a sort of a step backwards or as a shutdown again. We're going to have to be willing to take these sort of targeted measures in isolated cities as outbreaks occur and not view that as somehow a defeat. That's basically going to be life as we know it until we get to a vaccine. And we just need to have the fortitude to do it and not view it as another shutdown. We're not going to go to a simultaneous national shutdown again, even if I think this becomes epidemic. I don't think there's the political will to do that. And I don't think the American people would want that or demand it. But I think you're going to see targeted interventions at a local level. I think people are going to demand it in their local communities as outbreaks occur. And I think governors and others need to be willing to fit that into a policy framework without viewing it as somehow a defeat against the virus.
You know, Stephanie Ruhle tweeted something in the last day or two that I thought was a very good point. She said that her local New Jersey deli had been forced to shut down because contract tracing showed that a customer had tested positive for COVID-19. Her point was that wouldn't happen if the contract tracing showed that customer had gone to a Walmart or a Target or a Home Depot. Is that fair? I mean, we've already seen these small businesses face so much pressure. Is it fair to be shutting down the small businesses and not the big businesses when you see contract tracing showing customers have something like that?
Yeah, I mean, I think it's fair for public health officials to try to use contact tracing to figure out what a source of spread is. And I don't know the details of that particular establishment, but, you know, you look what happened in South Korea. It was a small number of establishments that became sources of spread where there were sort of super spreading events. And you needed to figure out what it was about those establishments that facilitated that. Were there workers who were infected, who were infecting customers? Was it just the fact that it was a congregate setting and it was bad luck? Some people with the virus had happened to come into those settings that night, that particular day. I think trying to figure that out is the essence of the public health work we're going to need to do, because if there's a certain facility where there's an outbreak underway and people are coming into that facility and getting infected and leaving, yeah, you have to shut that facility down. You have to make sure the workers self-quarantine so you break off the chains of transmission. And that's what we're ultimately going to have to do. We have the tools to do that now. that's better than shutting down an entire city, which is where we were in March when we didn't have the tools to do that kind of exquisite public health work.
Dr. Gottlieb, thank you. It's great to see you, and we will see you back here again on Monday to answer more of these questions. Thanks for your time.
Thanks a lot.
Andrew?
Okay. Thanks, Becky. Coming up, when we return, as Becky mentioned, a blast from the past. We're going to show you an interview, a rare one, with Warren Buffett the day after a major stock market sell-off back in 1962. Right now, as we head to a break, though, take a look at the biggest pre-market gainers in the S&P 500.
At BMW, we know leaving the road wasn't easy, but anticipating our return taught us to appreciate every drive. The exhilaration of the ultimate adventure. Moments spent with your favorite co-pilots. And the freedom to explore just because. Our time to rejoin the road is finally here. Get back on the road with 0.9% financing plus no payments for 90 days.
Between wisdom and curiosity, there's a bridge. Between ideas and inspiration, trauma and treatment.
Need a couple of more pounds.
That's good for the baby. Between the moments that make us who we are and keeping them safe, private, and secure, there's WebEx.
At Amica, we believe in life's extraordinary experiences. We are an insurance company that delivers an experience that meets the only standards higher than ours. Yours. Experience Amica. Auto, home, and life insurance.
Before you get back out here, gear up at Dick's Sporting Goods and Golf Galaxy. Grab a new Callaway Maverick, a tailor-made SimMax, or save up to $180 on select equipment. Plus, pick up a box of Callaway Chrome Soft golf balls. Check out our newest selection of footwear and the hottest new apparel. You'll earn triple points on new equipment purchases and 50% more on your trade-ins. Shop in store or shop us online and pick up curbside. All from Dick's Sporting Goods and Golf Galaxy.
Tonight, your playbook for navigating the new normal, reviving our economy, restoring American business. Listen live on the CNBC app.
The station you're listening to is experiencing technical difficulties. We have...
Welcome back, everybody. Those who fail to learn from history are doomed to repeat it. We're going to show you a clip of an interview with Warren Buffett from May 29th, 1962. That was a day after what was called the flash crash. That's a day in which the Dow lost 5.8%, and at that point in time, this was the biggest point loss that they had seen since the Great Depression. This, of course, was before people had a Bloomberg terminal or the internet or TV stations that would give you instant access to stock prices. Only ticker tapes could do that, and there was so much volume on that day that it actually took the tapes hours after the close that day to print all the trade. People didn't know for probably 3 hours after the close how much money they'd actually lost on that day, so you can imagine what they were feeling and watching as this ran up. Again, this was a bigger drop that we'd seen percentage-wise yesterday, but back then it was a pretty big deal, and it was a pretty significant move. Here's what Warren Buffett said the next day when he was interviewed on camera.
The stock market has been a good forecaster from time to time in the past. It also has been a rather poor forecaster occasionally. For example, the last 4 or 5 years, the stock market has been booming along, and presumably forecasting better business, which has really not materialized. Corporate profits are not any better than they were 5 years ago, but stock prices are 50% higher or thereabouts. So maybe the stock market is really correcting a previous incorrect forecast this time rather than making a new correct one.
In fact, this happened in the midst of what was called the Kennedy slide. The S&P 500 from December of 1961 through June of 1962 lost 22.5%. So that was a huge drop in the midst of a massive slide and a lot of uncertainty that was there. You had the Bay of Pigs invasion and other things that were happening. But after that, if you watched what happened, there was a huge S&P boom that took place in the years and years to come after that. So a big run up from that time on. Just goes to show that these things come, these things go. And the stock market can confound just about anybody at any given point. Guys, again, I had seen old pictures of Warren Buffett before. I'd never heard him speak before. A lot of the mannerisms are the same. And just to point out, he was 31 years old when he did that interview.
And I wonder...
Unbelievable thing.
Yeah, he'd probably say, if I knew now, or if I knew that, he's 31. How much has he learned? I mean, he has learned a lot, obviously. So I guess we shouldn't assume that he's the same person he is now, but that was pretty good analysis there and prescient. But you figure between 31 and where he is now, how many things has he seen and learned and put into put into his brain to come up with a lot of the things he comes up with now. Probably interesting to talk to him about what he was like back then, what he was thinking, mistakes he hadn't made yet, things he hadn't learned yet.
Yeah. One of the things he's learned now is don't come on and do television interviews in the middle of things like this.
I'm trying to remember what I was doing at 31. I don't think it was good. Definitely wasn't on TV talking about my investments. Investments.
His partnership, he had just put it together in January that year, and I think he had $7 million that he was managing at that point. So that was mostly friends and close family that he had put together with him.
I guess I was cold calling, now that I think about it. I was cold calling, prospecting. Anyway, using all those Dale Carnegie lines. You guys ever take Dale Carnegie? Should I go to break now?
No, but Buffett did.
Should I go to break now, or would it be 5 minutes now? Would that be better for you, Andrew? That's the alternative. Anyway, coming up, we're going to talk market strategy as stocks left a rebound from yesterday's 1,800-point sell-off in the Dow. Futures right now are indicated up 560 points as we head to break. Here's a look at yesterday's biggest decliners in the Dow and the S&P 500. We're coming right back.
Executive Edge is sponsored by AT&T Business with edge-to-edge intelligence covering virtually every part of your growing business. Learn more at att.com/edge-to-edge.
As business moves forward, we're all changing the way things get done. Like how we redefine collaboration, how we come up with new ways to serve our customers and deliver our products.
This one is cheddar. It's delicious. Oh, you look so healthy.
But no matter how things change, one thing never will. You can rely on the people and the network of AT&T to help keep your business connected.
Land Rover, above and beyond.
States of Play. CNBC and Change Research's exclusive survey. How the virus and economic crisis is impacting the critical swing states that'll decide the election. Special reports all week and on CNBC.com.
Jim and Joanne are here to pick up the same prescription. They both know the system is not on their side. They both know drug costs are out of control. But one of them is taking back control with GoodRx. So while he's paying that much, even with his insurance, she's paying this much just by using GoodRx. Use GoodRx to compare prices at pharmacies in your area and stop paying too much for your prescriptions. Download the free app today and take back control.
This dog is my heart. I want her to live the happiest life that she could have. To make sure she gets the best food is an easy investment for me to make. Doxy loves Farmer's Dog. It smells good, like something I could eat. Comes in these convenient little packs that you can tuck into your freezer. Made my life so much simpler. I want her to have a long and healthy life. Farmer's Dog is a good answer for that.
Visit betterforthem.com and discover your dog's recommended meal plan.
Good morning and welcome back to Squawk Box right here on CNBC. We are about 3 hours before the market opens. Let's show you U.S. equity futures at this hour after what was a very red and down day. We had red hours before yesterday's show. Today, Dow looks like it would open up about 572 points higher. S&P 500 looking about 63 points higher. The NASDAQ looking to open about 175 points higher. Let's also show you a couple of boards that we showed you just about this time yesterday. They were among the biggest losers, but look at airlines right now. You're looking at stocks in some cases almost 10% higher. United Airlines there closing in on 10% higher if we opened up right now. Let's also show you cruises and flip the board around, show you where they stand. They're also pressing higher as well this morning. And you're looking at Carnival Cruises up close to over 11% this morning. So a big rebound given some of the concerns yesterday, maybe about COVID spread, maybe about the Federal Reserve's comments about where the economy and unemployment may be later this year. Joe?
Yeah. I think we settled on COVID. I don't know, that's the headlines and all the, that's what it looked like, too. I don't know whether Powell said anything that earth-shattering. Anyway, the Dow coming off one of its worst percentage losses of 2020, falling about 7%, more than 1,800 points. Joining us to discuss what's next for the market, David Bianco, America's CIO at DWS, and Jim Keenan, global co-head and CIO of credit at BlackRock. And Jim, I'll get to you in a second because David, I think maybe, I can't tell for sure, but he may prefer credit over stocks right now. And I think that's what I gathered last time you were on, David. But I really want to drill down on that to see at 3,000 now on the S&P, what your actual advice to your clients would be. Would you be selling into strength if we rebound today because you think the market is overvalued and you say so? Or if it were to go down another 5-10%, would you be recommending that dip be bought? How do you really feel? And don't tell me, well, I'd do growth versus value or this versus that, or I'd wait it one way or another. What should an investor do right now?
Joe, it's always straight talk with you, and I appreciate that. Within your risk budget for market timing, I would sell this. I would sell this morning bounce. I think like the days like yesterday, there's more days like that to come. I think the S&P still needs to correct by about 10% from here to be within my estimate of fair value.
And then within that forecast, you make the point that growth is still better than value. People have been looking for a handoff, but that's not what you. So if you are going to be in the stock market or hold stocks, hold growth and risk light assets. Tech doesn't seem like risk light. I don't think you're talking about that there. You're talking about utilities and credit, right?
Well, that's exactly right. I mean, value stocks, energy, and lately financials, they've been the strikeout king. For 3.5 years now, growth has dramatically outperformed value. And I believe that investors should stick with growth stocks. And if they're looking for value, they can find value out of bonds, particularly from the issuers of those value sectors. We prefer the corporate credit from financials, from energy, from industrials, from many parts of consumer discretionary like travel. We prefer the credit over the equity. So buy corporate bonds and municipals for value and buy the stocks for growth. And when I say there's some other things in the equity market that are defensive, utilities, communications, infrastructure, those type of dividend-paying defensives, I do like those as well.
All right. Well, you're lucky. And we normally don't book guests based on helping each other out, but Jim Keenan is here. He's going to be able to tell you whether you're right on which credit to buy. He's managing, I don't think you're managing $115 billion in credit, are you, Bianco? So Jim, is David on to something? And what would you recommend him if he wants to stay risk light? Where should he go in credit?
Yeah, we do. I agree with David. We do like credit here. I mean, at the end of the day, I think risk assets are supported. You have an enormous amount of monetary policy and stimulus coming in. You have supportive policy from the fiscal side, and you have an economy that is reopening. So week on week or month on month, we do expect positive data, and I do think that's supportive for credit assets. To David's point, if you want to see from these valuations, equities really have upside. You have to really bet on the fact that you're going to see a significant recovery in some of the more cyclicals or COVID hit sectors. And, from a credit standpoint, I think, when you look at the markets right now, we have growth. You are recovering. It is supportive. And in the credit markets, you can get anywhere between a 6 to 8% type return by investing in, I would call it more, not immune, but I would say more resilient sectors. And I think that's a pretty good place to anchor your money at this point.
Well, it seems like you like credit across the board, because I'm reading what you're saying. You like high quality credit, but then some of the high yield and loan markets offer attractive. You're going up on the risk profile there, but you think you get more yield and it's worth it, and you can handle it.
Yeah, I think, there are credits right now within certain sectors, whether it's telecom, cable, healthcare, that you can actually go down the risk spectrum and earn a really nice return. And again, you're talking about a market right now where fixed income rates are sub 1%, and you're coming out of the kind of the March lows with a very supportive Fed. So I think there's an environment here where you can get, equity-like returns here without taking the same volatility that we've seen in the last 24 hours in the equity market in some of the sectors within the credit market that are not really making big bets on the recovery rates of some of the lodging, leasing, or transportation sectors.
So were you advising the Fighting Irish on how to do this, how to reopen? I mean, were you involved in that decision? They have an interesting way of doing it that when I saw it, I was like, good. They're starting early and then taking off early?
Yeah, I support Notre Dame and everything that they're doing there. But yes, I think in general, we're learning more and more about the virus. Obviously, that's going to affect different states and regions in a different way. But at the end of the trend is that we're going to start to reopen, and we're starting to get the more normalized level here. Jim, and Notre Dame's leading the way.
Jim, NBC and Notre Dame have that we have a pretty good relationship, right? I mean, are we going to be broadcasting? Tarico going to be doing those games?
I hope so. I certainly want to sit there on Saturdays and watch the games. But
will you make that happen? Fans or no fans, masks or no masks, could there be a year without Notre Dame football? I mean, is that the plus? Are you playing SC this year? That's always so much fun. Why are you laughing, Bianco?
Hopefully.
Yeah. Okay. All right. Go ahead, David. How do you top that? Yeah.
I'll just wrap it up with the idea that on here, DWS and BlackRock are happy to agree. The equity market's a bit ahead of itself.
Okay, good. All right. Thanks, guys. Let's see. Happy Friday. I guess that's what I'm thinking about. Fridays, DraftKings, football. Anyway, Becky.
2 hours and 15 minutes to go till Friday. Coming up, or I should say the weekend. Coming up, much more on yesterday's market sell-off as stocks aim for a rebound on this Friday morning. And take a look at some of the Dow components sending the futures higher this morning. Boeing's leading the way. It's been leading the way on the upside and the downside lately, kind of whipsawing the Dow around. This morning, it's up by 6.7%. Raytheon up by 5.8%, and ExxonMobil up by 4.5%. Squawk Box will be right back.
Jay Farner, CEO of Quicken Loans and Rocket Mortgage. During the challenging times we're all experiencing, our top priority is the health and safety of the communities that we serve. And while it's true that things are changing rapidly every day, one thing that will never change is our commitment